door.
We'll see you around the timeline. Feels good to be back.
I think the Rollup is one of the most premier media brands in crypto, and Andy and Robbie are great experts at everything they talk about, and it's my favorite podcast.
Adding it to my library as we speak.
Potentially multi-chain deployments.
We are at Dev Connect Day 1 here. I'm with Jesse from Base. JP Morgan, BlackRock, DTCC, Fidelity, the entire thing was just institutions. It's next level. This industry is going to the next level. And guys, I don't know what else to say. I'm bullish.
He said it, he finally said it.
I'm so bullish.
Andy's bullish, I'm bullish, we're bullish. Is headed to the top. If we're not already at the top, we're going to the top.
We're going.
Rollup is my favorite.
From all walks of life, all over the world, all over this industry, come together for the Rollup.
Zoom out. The institutions aren't coming. They're simply here. It's the golden age of crypto, guys. Get right. Let's go. Welcome to the nest. See you on the show.
What is going on, ladies and gentlemen? Welcome back to the Rollup. I am here live from Miami, Florida. Everyone else is coming to Miami, Florida next week for Consensus Miami. We are absolutely stoked. We've got a dinner. We've got an event. Shout out to the Modern Money crew. We're not in the Tokenization Tower today, yet our friends at Plume are. They're holding down the nest. Andy's in El Salvador. He's in Bitcoin Beach. So I am going to be running the show today. And so we're doing it from Miami. We're doing it down here in South Florida. And we still love our friends back at the nest. Shout out to Plume. Guys, they're holding down the tokenization tower while we are coming at you from the south. Guys, it feels good. It's another beautiful day in Florida. And so we are going to be having a great show for you guys today. We've got a stellar lineup. I think we've got 5 guests today. That is the most amount of guests that we've had in a long, long time because there's a lot going on and we want to bring you guys the best of the best. So we've got Adrien from Portofino. We've got Shehram from Trust Wallet. We've got Patryk from Serotonin. They just released a very cool report on, I believe it was on the state of on-chain finance. We're gonna talk a lot more about that. But very, very cool. They were able to release that report from Serotonin. 1KX is going to be joining the show as well. We've got Lasse Clausen, who's going to be joining from 1KX. And then a late addition to the show on the heels of the announcement from Securitize. Guys, you don't see it on today's topics because this was breaking news that we're going to be hearing from the man himself. Billy Miller, the COO of Securitize, is going to be joining the show to cap us off and tell us about the latest announcement from Securitize, which we're going to cover in our news section, and then we're going to have a lot more to talk about with Billy later on. So I'm extremely excited for our show today. It's going to be another great show. Before we get into our news section, shout out to Frax. Guys, our exclusive stablecoin partner. These guys are building the future of digital money. We are friends with Frax. They're doing a great job. We saw Sam on the stage at Bitcoin Las Vegas, which was absolutely incredible to see. He was beside Patryk Witt. So it's cool. Sam is playing a little bit of a different game, I think, than the rest of the stablecoin providers. You know, Circle's been on some hot water. Tether's been making a ton of investments. Sam just continues to position himself next to the leaders in DC. This feels like where you got to get a seat at the table in order to make an impact in the stablecoin world these days. Guys, it's a warm one. I think New York is warm these days too, but it's warm here in Florida. This is just a little bit of a shout to everyone who's going to be joining us next week. Like I said, we're going to be partnered up with the Momentum X crew. These guys throw tremendous events. We're going to host a dinner. That one's a little bit more exclusive for some of our VC friends. And then we've got Modern Money, the event series that has been all over the world. You guys saw it in New York. It's coming to Miami. If you guys want to attend, hit us up. Do a little due diligence. I'm sure all of our friends watching the show certainly will make the invite and we'll get you guys out there, have a drink or two, and we'll have a great time at Modern Money in Miami. So our weather section is sponsored by Relay, guys, from New York to Miami. These guys will take you cross-chain wherever you need to go. Go to relay.link in order to take their cross-chain bridge. I think I was saying on the show recently, I was recently cleaning up some old wallets, had to bridge some things, consolidate some things, and consistently in the aggregators, Relay came up as the most efficient route. And so that's just a little bit of firsthand experience on the bridging world, which I think Intense just continues to show. You know, if you look at Near Intent, you look at Relay, and you look at LeFi, and you look at Across, these are the intent protocols. They're doing lots of volume, and they're not getting exploited like we've seen on some of these other one-of-one DVN bridges. So shout out to Relay for sponsoring our weather. That is the weather section for today. Prices are, you know, these all show red, but everything's pretty much flat. You know, Bitcoin's flat, ETH is flat, hovering around that 22 to 2350 mark. Bitcoin has been back between that 75 to 78 range. You know, we had that pop from the high 60s all the way up to these mid 70s here, mid to high 70s. And it just feels like, look, we just got to continue to push the needle in order for sentiment to match the prices that we're seeing on the charts. We're not quite doing that. You know, we had that run up And now we've stagnated. It feels like we've plateaued around these levels. This all kind of feels like chop. Everything is macro correlated. We've got a big, big day today in the traditional world. We've got a FOMC meeting. That'll be coming out during the show. And so we're going to be bringing the news to you guys here. It does seem as if no change is going to be the resolution from Powell's last event. Give it up for Powell, guys. Man, he had a hell of a run. Hell of a run. Powell, this is his last FOMC. Then we're going to be welcoming Kevin Warsh. It seems like his committee is going to get approved. He's going to get confirmed. So this is the last that we're going to see from Powell. Guys, if you want to hear from Powell, I'm curious, what questions would you ask him? You guys know they do the press conference, and then they ask him a hell of a lot of questions in the coverage afterwards. Give us a hit in the comments. What would you guys be telling Powell? What would you be asking him on his last FOMC press conference today? Should be a nothing burger. It's believed to be no change according to the prediction markets. I'm curious what you guys want to hear from Powell on his last meeting today. As always, markets are sponsored by our friends at Zama. I do believe Zama is part of the privacy-preserving ethos of crypto and digital assets. Bitcoin has been commandeered by Saylor and the rest of the institutions. And so we've got Zcash leading the way as the cryptographic currency, really resurfacing and reaffirming the ethos. I believe Zama fits firmly into the category of privacy, which we've been talking about so deeply on this show. It's what institutions want. It's what the crypto natives want. Zama is bringing FHE to the masses. They're also tokenizing treasuries to the tune of billions of dollars. They're doing that with T-Rex, and I expect a lot more out of Zama. Shout out to Zama for sponsoring our markets today. Guys, let's keep it moving. Like I said, a tremendous show for you guys today. Oil is spiking while we're on the markets, and then equities. We've got an incredible lineup of earnings calls that are going live today. This is the most significant week when it comes to the equities markets. We're still ahead of the IPOs. Elon is taking Sam to court. We're going to get into the earnings calls, and this does. It feels like this means kind of make it or break it time for equities that people feel like are overheated. We'll see if this number go up. Technology continues to work its magic. Before we get into our news for today, let me tell you about Near, our exclusive AI partner. These guys are tightening up Iron Claw. They have deals in the works, I hear, with major institutions, maybe not the institutions that you guys are typically accustomed to hearing about. Maybe it's not the financial institutions. Maybe it's large institutions. These guys are AI-ifying the entire world. Get on, really, because the longer that you go without an Iron Claw, the farther you fall behind. And I'm sorry to put it that way, but that's just the reality of the situation. You guys can go to nearai.org to go download Iron Claw. Get caught up to your peers. Another thing that's going on right now. Nicholas Stelzner. Don't buy a home right now. Wait 3 years for prices to come down. This is the worst time to buy in American history. Rent for now. This is incredible because you have two things happening. On one hand, you have the most overheated housing market in history in America. There was some housing data that came out today about how sellers are lowering prices at an incredible rate. And so prices are falling. You don't want to be buying because prices are continuing to fall. People feel like this is just getting started. We haven't yet seen equities match this. And so it feels like a lot of things are starting to come together. Paul Tudor Jones went on a podcast recently, said this bear market feels like it's the easiest one to predict. It looks just like 2000, right before we had the dot-com bubble as it was overheating. And then obviously 2001 happened. It feels like housing crisis are converging at the same time that we're getting equities overbought. I feel like super pessimistic, super doomerism saying this, but on one hand, you have the housing data showing us that housing prices are coming down. It's a good time to wait to buy as you see housing prices bottom. And if you're trying to sell, it feels like it's now or never, or else you're going to be locked into your home for another few years. On the other hand, we've all seen these charts where, hey, there's the most amount of young adults, specifically young men, that are unmarried and don't own their home, that are the average age, the medium home buyer average age continues to increase. I think it's at least in our 30s, if not in our 40s, that we're seeing the median first-time home buyer finally purchase a home. And so you kind of have this dichotomy happening where, people see these metrics. They don't want to be another statistic. They want to buy their home sooner rather than later. But at the same time, we have the quote unquote experts and the data telling us don't buy a home right now. And so just continue to play into the statistics. Doesn't matter that the medium home buyer is continuing to raise in age. Doesn't matter that you're unmarried and you don't own your home. You will own nothing and you will be happy, at least for the next 3 years. And then maybe prices come down, they bottom, and you want to buy the dip. People are always going to need a place to live. And so if you're patient and you've got time on your side, which young people do, whether you buy a home now or you buy a home in 3 years, I don't think it really matters if you plan on living in that home. If you plan on renting that home out, being a landlord, playing the real estate game, that's an entirely different game, in which case you might want to take this housing data more seriously. However, if you're planning on buying a home, living in your primary residence, 3 years from now versus today, it's not going to make a big difference 20 years from now when you're looking to move from your primary residence or buy a second home. That's what the affluent individuals are doing here on the Rollup. Guys, let's keep it moving. Pretty interesting things happening across the equities markets and the real estate markets. Over here in crypto land, in digital asset world, we have Blockworks. This is a proud portfolio company of the Rollup. I think that is the first time that we're mentioning this on the show. You guys might be thinking, Rollup, Blockworks, aren't you guys competing? What are you doing? Why are you investing in Blockworks? Good Idea Ventures invested in Blockworks in the most recent round at the $192 million valuation. We believe their data product is an important addition to the institutional wave. And so we are thrilled to help announce Blockworks has made this raise pretty incredible. Crypto is at an inflection point. The bottleneck to growth is no longer its technology. It's the trust gap between issuers and investors. And it's time to get the issuers and investors on our side. Blockworks will help solve that. That is why Good Idea Ventures decided to write a check to our friends at Blockworks. Let's play the video. Congrats to Blockworks. Good names here. I think you might have seen. Let's let this clip play again. Was that the Rollup logo? Did that flash in there? One of these days, guys, we're going to be up here with the big logos, writing the big checks. Oh, the Rollup, look at that, guys. Made it into the Blockworks video. Shout out to our friends over at Blockworks. This feels extremely complimentary, especially now since Blockworks has effectively sunset a lot of their news desk and some more of their media business. And so, as we continue to proliferate into the media zeitgeist, we believe Blockworks is an important piece to the data stack. So there it is. Our editor did a great job. He's able to pause the video there. Nice work behind the scenes, guys. Yeah, so very cool. The Rollup and Good Idea Ventures very proud to support Blockworks on the next leg of their journey. You guys saw this is a Series A extension. Yano and Mike doing great jobs. We were at DAS. We were supporting there. The first in real life podcast that we did on the show floor at these conferences was permissionless. And so it's very cool to see the partnership between Blockworks and the Rollup continue to deepen. Nothing but the best for those guys there. Plenty more that you guys can expect between our partnership here. Very, very excited for that. Let's keep it moving. Shout out to Blockworks, Series A extension. Guys, this is what I wanted to get to. This is what I'm excited about today. We've got Billy Miller, who's going to be coming on the show later today to talk about this. Now we've got Carlos Domingo, the chief over at Securitize, announcing an agreement with Computer Share. Guys, you may not be familiar with Computer Share, but they are the world's largest transfer agent. They manage close to 60% of the S&P 500, including the biggest companies that I'm sure you've heard of. Companies like Apple, Tesla, Microsoft. A lot of these guys have earnings calls today, so it couldn't have came at a better time. Nvidia, Disney, Coinbase. These guys, Computer Share, help manage these companies as the largest transfer agent of the S&P. They become the tokenization partner for Securitize to bring stocks on-chain natively in the US and abroad. They said it couldn't be done, and then Securitize, Carlos, Billy, Tom, all the guys behind the scenes, they went out there and they did it. And so now we have on-chain native stocks in the US and abroad, retaining the same rights and economics that allow them to trade and borrow on-chain. Guys, the name of the game here is the plethora of value propositions and use cases that become available to these assets. Think about all the shareholders that don't want to touch meme coins. They don't want to touch tokens because value accrual has been broken in this industry. Let's first recognize the problem. Value accrual to tokens has been broken for a long, long time. The equities market has worked for hundreds of years. Over 150 years, we've had equities markets that work. Now we can take assets that have figured out value accrual and we can layer on the value propositions of blockchain and permissionless finance. Guys, this is a match made in heaven for anyone who is against RWAs, which I think people are finally coming to their senses. They realize that we need high quality assets on chain. And then all of the protocols, all of these fancy DeFi Legos that we know and love, as long as they're secure, we don't have any hacks, these things are able to finally benefit from the onslaught of quality capital and quality assets that will be entering the space. Shout out to Securitize for leading the charge. Guys, clip that. Securitize is leading the charge. Absolutely incredible to see. Carlos Domingo and team. Why don't we scroll down? Is there more? Tokenize the world? Is that all we've got here? If it is, that's incredible. These guys are doing great work. Very, very cool to see. And so big shout out to Carlos and the rest of the team. And I'm very excited to chat with Billy later on in the show. We've got plenty of questions about what this means, how quickly this capital can come on chain. When they're working with Computer Share, do they need to go work directly with Apple, Tesla, Microsoft, Nvidia? Or is this a one-shot distribution channel in which all of these tokenized equities will now be coming on-chain? Once they are on-chain, what are the biggest value propositions are they looking at? I've got a ton of questions. I'm excited to chat with Billy on the show later today. Let's keep it moving, guys. We've got our first guest here in 6 minutes. We've got a few more things to talk about with you guys. We mentioned this early on. This is probably bigger than the FOMC meeting. I don't know if it's bigger than Securitize working with Computer Share, but it's going to be an eventful day. The Nothing Ever Happens crew is putting their reputation on the line. Google, Meta, Microsoft, and Amazon. I believe that's 4 out of the Mag 7 are going to report earnings after the market closes today. I'm not going to speculate, but I do believe that we're seeing some risk taken off the board as a sort of hedge in preparation of these earnings calls. Google, Meta, Microsoft, Amazon. I mean, we see what happens when Nvidia announces earnings, right? There's so much weight in the Mag 7. I don't know. I don't have the number offhand, but it'd be easy to find out. I want to say it's almost half, if not more than half, of the S&P is in the top 7 equities, which is incredible. And so now we have more than half of those 7 equities, which would account for, I don't know, maybe a third to the entire stock market, is announcing earnings today. So obviously this is going to have significant, meaningful impacts on the market at large. As a whole, we're going to basically be said later today, after the market closes, we're going to get earnings. I expect Hyperliquid to be a beneficiary here because a lot of these equities are listed via HIP3 on Hyperliquid. And so we're going to see some movement after hours. $12 trillion worth of market cap is going to be reporting on earnings within a 30-minute window. That's a lot of market cap. And then obviously we've got the Fed interest rate decision at 2 p.m. and then oil prices surging toward $105 a barrel. I think we're seeing risk come off the table. We'll see how this shakes out, and then we'll see risk enter back on the table, depending on how these earnings calls go. But obviously, the entire market watches and kind of hangs in the balance here, undoubtedly, as we see earnings get launched. Very, very meaningful day here for the markets. Buckle up, guys. We approach the month-end close. We got the FOMC, and we've got 4 out of the Mag 7 announcing earnings after the bell today. Let's see what's next. Yes, STRC, the stretch product that Saylor has had so much success with. We had multiple people come on the show. We had Etherealize. We covered that clip. I've been preaching this. It just makes sense. If Tom Lee has seen the success that Saylor has had with his stretch product, which I'm sure he has, it just makes sense that we see a stretch product from Tom Lee and Bitmine because Ethereum has yield natively baked in. If you guys are unfamiliar with stretch, it's basically an 11% note that Saylor is issuing to people to LP back capital so that Saylor can go buy Bitcoin. So Saylor issues like a note, a bond effectively, says, I will pay you about 11% on your money. You give me the money, I'll give you 11% back at a time later. And I'm going to use the money that you give me to go buy Bitcoin. And that is how I'm going to go and finance the 11% that I'll pay you back. For a long time, he was able to raise money at 0%. Because people just wanted the Bitcoin exposure. They wanted the lever bet on Bitcoin by buying MicroStrategy. Now it's gotten a bit overextended, but he's still having tremendous success with Stretch. It feels like Ethereum and Bitmine are ripe for an opportunity to issue a similar Stretch-like product. Let's play the clip.
You see how successful STRC has been. When does Tom Lee do this for Bitminer? It's actually a much more compelling pitch because you get yield on your ETH, right? So you can fund quite a bit. He's sitting on, I think like 12 billion of ETH, right? And so you call, let's say 3% on 12 billion, 360 million on a 10% preferred. So you can fully subsidize close to 4 billion of ETH purchases. And then there's obviously reflexivity there and all of that. So I feel like it's a very logical thing for him to do with how clean the capital stack is there, and should be pretty bullish for ETH if that can happen. If you see how...
So this is what we've got. Man, it does feel like there's a clean capital stack. Look, Saylor is issuing debt at 11%. He did less previously because there was demand for products at a lower APR. This is how these things work. Less demand, still got a supply. You need to raise the price. And so, or excuse me, you need to lower the price, which means raising the interest rate. And so Saylor did that. When they say the native interest rate embedded into Ethereum makes this an easier choice to do, they're talking about the staking rewards rate. There has been discussion lately about lowering this rate. Look, the inflation rate on ETH right now is less than 1%. I think it effectively, there should be some demand at less than 1%. I think we can probably leave the staking rate where it is. Obviously, they're scaling the L1. You don't want to scale the L1 too fast, or else, you're not going to end up triggering this burn. But less than 1% of inflation per year feels like a pretty reasonable value. Obviously, that's less than what we're seeing in the dollar world. So feels like that's a pretty reasonable amount. And then what you have is that you have this 3% yield. Bitmine can just issue that yield. They're going to be one of the largest capital-intensive products in the world, meaning that they're going to be driving so much revenue just by staking their ETH. Because ETH has this native revenue generation, this native yield embedded into it, they can just collect. All they have to do is put together a large enough basket of ETH in which they're very much working on. I think they're nearing their target of 5% allocation in the network. And so they are going to be in for a wild ride here. If they can issue this stretch product, if they can buy more ETH, and then they can also, collect and have very secure staking rewards. I'm excited. You guys know me. I still believe in Ethereum. I tend to think that all these haters, look, I think the new L1s are the New York Stock Exchange alternative trading platforms. It's the NASDAQ coming on chain. It is all of these traditional brokers that are going to be launching their own equities, tokenized equities trading platforms. These are going to be the new L1s. I still think when it comes to interoperability, when it comes to shared settlement, there needs to be a world. It's not the DTCC, guys. It's not the DTCC. I am going to Consensus Miami. I'm going to be on the stage with Joe Lubin. I know he's working with DTCC behind the scenes, but we're going to have, he's also obviously pushing Ethereum as the shared settlement layer. I tend to believe we're going to see a lot more from Ethereum. People are just hating on it. I think they're hating on ETH, the asset. They're not hating on the chain, but guys, ETH isn't going anywhere. Sorry to break it to you. ETH isn't going anywhere. You got Ansem calling for the destruction of ETH. It's not going anywhere. Let's go through a couple more pieces of news here while we set up our guest in the back. We've got Sandeep, the head of Polygon Foundation. We've got Visa, the world's largest payment network, has now turned on Polygon Rails for its global stablecoin settlement program. Visa's partners can now move money instantly on Polygon. This is pretty incredible. Pretty incredible because we see how much Stripe and their whole payment network has pushed into Tempo. The founders of Stripe are pushing on this. They believe this is where the future is headed. Obviously, Visa has their payments partnership network as well. The names that are going to be settling include some of the biggest. MasterCard, Flutterwave, Stripe, Revolut, BlackRock, and Visa. Pretty insane list of partners. If anyone could do it, Sandeep could do it, and he did it. And so that is pretty incredible to see. Big shout out to Sandeep. He was able to pull off what people were a little bit skeptical about when it came to the pivot from the general purpose rollup or chain that Polygon was, not necessarily a rollup. They said that they were going to be focusing on payments. It felt like they were behind. It felt like they were trying to play the traditional fintech game, but they've come out, and Sandeep has successfully, and Mark, shout out to Mark as well. This is huge news from Sandeep and Mark and the entire Polygon Foundation. So very, very cool to see. Do we have any more news? Maybe one more. Let's go to our last piece of news here while we pull our guest in from the green room. We'll go to our last piece of news. But yeah, big shout out. Polygon has been friends of the show. I'm sure we'll get them on the show here relatively soon to talk about everything that has been going on in the payments world as of late. All right, our last piece of news here is from Lily, the Solana Foundation lead. She talks about the positive sum culture. They've always been pretty open, tried to welcome the best builders, tried to cultivate a culture of open meritocracy and let the best builders win. That feels like the free market, libertarian, capitalistic society that we've built on chain, the one that we know and love. One of the things that they focus on is always looking for positive sum games because it's easy to find the zero sum games in bear markets. A lot of people are looking to see who they can take a longer term perspective with. Guys, that is one of the best things about bear markets. You don't have people here making a quick buck. You got people here in the trenches. They're looking for long-term partners. They're looking to build something of value. And that's why the roll-up doesn't go anywhere in the bear markets. We build right through. The only way out of a bear market is to go right through it. So shout out to Lily from the Solana Foundation. I think we're ready for our first guest. Pretty incredible lineup for you guys today. 5 guests, and we're gonna get into it. So let's get into it. Let's bring up our first guest. We've got Adrien from Portofino. Let's go ahead and bring him up. Adrien, welcome to the show, man.
Hey guys, nice to meet you, Ruby.
Absolutely. What's going on, man? It's a pleasure to see you. You're head of sales over there at Portofino Technology. Why don't you give us a little bit of background on Portofino? We'll dig into what you guys are doing.
Sure. I mean, Portofino, company founded in 2022. Basically, in 2021, most of the team was at Citadel Securities. They wanted to trade crypto, but crypto back then was still a bit a regulatory Wild West, so Citadel was not too keen on doing it. The team decided to do it on their own. We raised 50 mil, led by Peter Thiel, got regulated in the different jurisdictions, built all our tech, opened the client franchise in 2025. And yeah, basically, like, you know, we try to do like to bring HFT in terms of like crypto native and to behave as an elite boutique for the market, basically.
Very cool. So you guys are a crypto native, high frequency trade, grade market maker focused on real liquidity. Now, you know, if we think back to the beginning, you mentioned a lot of you guys were early at Citadel. You guys wanted to get into the crypto world, start market making here. Now, as a market maker, you guys love volatility, right? And early on in crypto, there was a lot of volatility. Why did it not make sense for Citadel to come into the crypto world early on?
I think, you know, like generally the volatility in crypto is different than the volatility in traditional markets. So I used to work for an investment bank before, and obviously when you had volatility, whether it was up or down, it was a marvelous moment for any traders on the market. In crypto, it's a bit different because I think, you know, like everyone is naturally long. If you're in the ecosystem, you're naturally long. You know, like your balance sheet is crypto denominated. You know, like market makers have models, business models that work mostly if price goes up, unless those market makers are behaving rogue. But that's not what decent market makers should do, let's say. So generally, the upside volatility is extremely beneficial in crypto for everyone. Downside volatility is painful for everyone. And it's also because downside volatility creates bankruptcy, creates like a lot of struggle overall for the ecosystem. And that's not, you know, in a young market, the kind of market where you can thrive if people around you are dying, you know.
Yeah, no, it makes sense because a lot of crypto traders are long, right? Just by the nature of this industry, still very early. And so because a lot of that is one-sided, you don't have a very healthy market structure like you're saying. Speaking of market structure, I mean, look, I got to ask you, you know, we've seen people are still talking about 1010. Like, there was, you know, and they call it a few different ways. They call it a glitch on Binance. They call it auto deleveraging on Hyperliquid. You know, they refer to some different things. Ultimately, there was this cascade of factors that ultimately all kind of fit together and led to the 1010 fiasco. Do you think we've recovered? Did the market structure break? Is it now fixed? Or where are we right now when it comes to the market structure from a market maker such as yourself?
I mean, I think there's a bit like a double factor when it comes to just like the market structure and the liquidity in the market. First, obviously, like you need to think of what was the trigger, and I think the trigger was clearly 1010, and you clearly see that on the markets in general, for almost any market, in particular the altcoin market, the liquidity has been divided by double digits. From that moment, you know, like I think for most markets we're talking about like 30 to 50% of liquidity down from 1010. So obviously you got this trigger, but then you also have to think in price, you know, like ultimately like the liquidity decreasing, like, you know, if you quote in token terms, the liquidity has not necessarily decreased in token terms on some markets, but it has decreased in dollar terms because prices are down. Yeah. So if the price is down, like obviously 30% since 1010, you may still quote the same number, the same quantity of token, but because the dollar value is down 30%, naturally you have this drying up effect. So I think there's a bit this double side where you do see 10-10 as the trigger, but there's a price effect behind that shows that liquidity has dried up.
Yeah. Another aspect to the market structure that we have more recently has been these ETFs. I'm seeing IBIT flows. I've also seen recently that there is extremely high funding that shorts are paying. To go short on Bitcoin, you have to pay an extremely high funding rate. And so people are saying, why would you want to be short Bitcoin right now? Maybe they're, very high conviction, but they have to pay such a high funding rate. Can you explain what is happening? Are funding rates for Bitcoin shorts really this high? Is it just Bitcoin? And why is this the case?
I mean, I think, generally and we were having this discussion earlier today with some clients, but generally in crypto, you will struggle to find people willing to sell puts or, to sell this kind of exposure, So going short or protecting your downside is a very expensive trade overall in crypto by nature. Why would it be on Bitcoin? It's a harder one, I think that, when we talk about altcoins in general, you have to think about the overall tokenomics, you have to think about VCs and so on. Obviously, you don't have this part on Bitcoin. I do think that talking to a few high level guys in this industry, I think that a lot has changed with the quantum risk overall in Bitcoin, and that a lot of the people that were, or institutions that were buying Bitcoin as an equivalent, a digital equivalent of gold, meaning a 0% risk asset.
Right.
Now, even if you price the quantum risk at 1%, it's still not a zero risk asset anymore.
Yeah.
And so I think it may have triggered, also some, first some selling, but also some people that are willing to, hedge also their flow.
Yeah. Okay. So if you're not, paying so much attention to maybe the ETFs or funding rates, what are you paying most attention to? What are the metrics out there, the indicators that you're paying the most attention to right now?
In terms of
the digital asset landscape right now, in terms of what you guys are trading, what indicators are you paying attention to?
Obviously, we look at just the overall option market, the future forward market, prop market. What we have to look at more generally is also just you have some indicators that are also indicating the general risk taking or the general the appetite, I would say, in the industry. And this can be very varied, obviously you can think about the VC rounds, you can think about exchange listings, you can see about taker flow on exchanges, you can just try to also understand what kind of players are you trading against. Is it systematic flow? Is it retail flow? What kind of, who's in the book, And ultimately that gives usually a quite good, let's say, vision of what's going on in the market. I think that, just generally, we also, we monitor also a lot of the DeFi metrics, and, we try to understand what's the activity out there, what people are willing to do or not do, and just general healthiness, I think that even for a company like ours that is mostly active in centralized exchanges, we do a bit of DeFi, but mostly on centralized exchanges, we can't ignore what happened to Drift, the whole CapDAO situation and so on. Those things are obviously a big part of the environment, and drive OTC flow, drive specific requests and so on. So everyone is impacted, right? Even if you're not directly into it.
Has the recent hacks like Drift and KelpDAO, have they sort of put a bad taste in your mouth when it comes to Hyperliquid? I take it centralized exchanges, like you said, you're primarily trading there. Have you done any market making on Hyperliquid before and after the hacks?
So, I mean, we've been doing it in like small size, like for us, it's an area of growth and that's something we can scale. But I think for, I would say, TradFi traders or for centralized traders, going into DeFi, you have to consider a new bunch of risk, whether it's like hacking risk, or you can just also consider that transparency is also a risk, or different things that are not necessarily like potential risk, let's say, on your regular centralized venues.
Yeah.
So I don't think that I don't think it raised the question on whether we should do it or not. We should definitely do it, and we want to do it. I think the question is more like how to make sure we do it properly. I think it's very easy to go head down into it and just think that it will be a Binance-like experience because anyway it's a centralized limit order book. I think it's not.
Yeah.
Honestly, we have to deal with those differences.
Yep. And recently we've seen Hyperliquid get significantly more traction and volume and open interest in the non-crypto assets. HIP3 has allowed Hyperliquid to list oil, and we've seen Hyperliquid get 2% of global oil trades going through Hyperliquid. This was incredible. Also equities and pre-IPO assets like Anthropic and others have all listed on Hyperliquid. They're doing extremely well. It feels like sometime soon we're going to see the non-crypto assets on Hyperliquid supersede the open interest and volume of crypto tokens that are making up the volume and open interest on Hyperliquid. As a market maker, and you see more of these assets become tokenized equities, you're seeing a lot more of these digital assets trade 24/7. How are you reacting to these quality assets, these equities that become, tradable on something like Hyperliquid? What is your reaction to this as a market maker?
I mean, the demand for that is huge. Like it comes from protocols, it comes from centralized exchanges, it comes from all over the place. And I think the trend is very clear on that. I think from a market maker perspective, like it can be a tricky one because the pricing on trading hours is pretty straightforward, right? It's as if you trade with an oracle. Like you have a price feed and you're just like, okay, so this is what the market is somewhere else, so I should just like basically replicate that, and if I manage to make the spread between this venue and this one, I'll make money, I think the big question is more like what happens in the after hours and who you trade against. Like I think one of the big questions that I personally raise seeing those volumes is it's definitely not retailed, so there's definitely institutional or high net worth, let's say, flow that is going to that. Is this flow non-informed or at least as informed as us, or is it insider flow? And I think that's one of the big questions that you need to answer the moment you start trading on after hours, non-KYC, etc. avenues, because it can also attract a lot of people, as you can see on Polymarket, also like all those insiders that are winning their bets,
Right.
So it can be related to that, and so obviously the market works when everyone is on the same level of information. And if you start trading against against an intern that is in the almost straight, it becomes much harder, to know if your pricing is right.
Citrini Analyst 3 lore runs deep. Makes sense. Yes. How do you know this isn't retail flow on these exchanges? Like what signals to you like, oh, this has to be institutional or high net worth individuals?
I just think it's more like, past a certain size, and past a certain size, it's hard to imagine that, if it was just retail flow, like probably all our friends would be all over it and on their phone like 24/7, to trade like on retail sizes, those assets. So when you reach a share of the global volume, let's say, that is like so significant, you know that there is some systematic flow. And if it's just systematic flow, like, algorithmic trading companies, I don't think it creates that much of an issue. I think what you have to be mindful of is always more like, okay, what's my pricing? And is my pricing correctly reflecting everything I can know? And am I trading against someone that obviously, is more informed than I am?
Right. And, Adrien, in general, given that, you guys are a proficient market makers, backed by Peter Thiel, and, you have a lot of friends that came from Citadel, in your experience, I'm curious, do you think trading is a zero-sum game?
It tends to be, it's like you always need a winner and a loser on the trade, unless it doesn't move, unless you're trading a stable coin and you just consider that your cost of trading is the fee. But the moment the asset is moving, I believe that there's always someone that does better than someone else.
Got it. And it does seem like, in the token world, like in the crypto digital asset world, it feels like that's true. It feels like, there's insiders, they win, retail loses. It does feel like that. Maybe that's because there's a long bias in, the digital asset world. But in equities, it feels like, well, these companies are doing real work, right? Like they have customers, these customers pay them for services or products. These businesses generate revenue, and then the value, accrues. It feels like it's positive sum. It feels like the customers, they get the service or product, they get what they pay for, and then the company makes money, and then everyone's happy. It's not zero sum. It feels like maybe crypto is zero sum, but the equity world is positive sum. Do you see it the same way?
I mean, that's the whole debate between being a utility and a security, right? I think that, when the whole, probably from 2017 and even more from 2021, why those tokens got so much attention, it's because obviously, there was a whole part of irrationality and chaos, which is pretty common to any new market, but also because people were seeing it as a proxy to the performance of something, which ultimately doesn't give you any right, but if you were a VC, if you were an angel, if you were like even a retail investor or whatever, and you were like buying a whole bunch of token about a protocol you believe is the right one, you were making money on the fact that this protocol has built a product and has hype and users and so on, because the demand was just very high and was much higher than actually like what back then people were selling. And so for everyone, it was a good proxy of the success of what they were buying. At some point, obviously, I think, and it took, a bear market, it took tokenomics to hit, if you think about most tokenomics, we're talking about, let's say 2 to 4 years for tokens to be fully released and so on. People realized that first, tokens were not giving them any right. So you could have a founder that was running away with the money. They were also realizing that, even if you were creating some buyback programs and so on, it was still not being entitled to a dividend or being entitled to, the right to say something to the board of a company, kind of. And I think that just generally, in the current market, we're more paying the greed of the different stakeholders than anything else. Like, if you think about like a few years ago, everyone, VCs, investors, exchanges, market makers, probably other type of companies as well around the projects. Everyone, and projects too, were making a lot of money on the fact that there were like retails that were getting in. And one of the only things that exchanges were monitoring for listing was the number of Twitter followers. So, so at some point, I think that retailers also understood that they were used as an exit liquidity and that there was not a value offering.
Yeah, it was a pretty unsustainable game that the token world was playing for quite a while, and then obviously that became more public as we had people like Kobe putting together the papers around low float, high FDV. The incentives were such that no one wanted to talk about this because, if you got in early, farmed the points, you were able to do okay. Retail was able to make a little bit of money. VCs were able to make a lot of money. Every private investor was able to make a lot of money. And so it took like kind of this unincentivized person to come in and kind of expose what was really going on here. I'm curious, as we wrap up, we've only got a couple of minutes left. What are the assets that you think are most attractive, not financial advice, but just things that your indicators, your market making techniques are signaling to you, hey, these things might be uncorrelated. This might be something to watch. What has caught your eye? What's been most exciting on your radar as of lately?
In the crypto in general? Or
Yeah, crypto, but also broadly. Like if there's, commodities or utilities or equities that have caught your eye as well.
I mean, I think, in crypto right now, it's all about quality. So, you have to think about like the product about the protocols that actually have a product, that actually have users, generate revenue, and so on. I think that's the only sustainable way of looking at it. When it comes to the general market, I mean, I think that U.S. equities, you are under Trump, that he's doing everything he can to have a Fed chair that will cut the rates and to have the equities that are like skyrocketing. So obviously like S&P right now is and Nasdaq are doing like pretty well. So I think it's the easy one. And then I feel commodities requires a bit more understanding of the drivers of the supply and demand, right, compared to just buying an Apple stock. But obviously, there's a lot going on the equity side, whether we're talking about like energy or metals, especially. So to someone that is willing to understand, the drivers of those commodities, there's definitely a lot going on right now, and it's worth looking at.
Absolutely incredible. Adrien, thank you so much for joining us. It really is a pleasure. I feel like there's opportunities out there if you know the right places to look, and you guys are doing a great job of looking in the right places. So, Adrien, thank you so much for joining me.
Thanks so much for having me.
Yeah, we'll see you next time. Thanks, Adrien.
Bye.
All right, guys. Well, we just continue to blitz through the best in the business. You guys just heard from a Peter Thiel-backed market maker about everything that he is seeing when it comes to the right indicators to take a look at, the right assets to watch. And then obviously in general, like I like to get kind of philosophical, to be honest with you guys. Is trading a zero-sum game? It really does feel like in the equities world, but also increasingly in the crypto world, if there are real businesses with real customers, they're happy to get the service, the product that they paid for. Business is happy to make money on that. However, if you have, tokens that are just preying on, fake user metrics, they're selling that to centralized exchanges, then you get insiders making a ton and retail is just getting shafted. That's not a real business. That's not a real product or service. And so obviously we've got a different scenario as it comes to, positive sum, zero sum between equities and tokens. Something that I anticipate will continue to play out as we get deeper and deeper into value accrual on chain. And so coming up next, we've got Shehram, general counsel at Trust Wallet. I think the title's getting a little cut off there, so we're gonna go ahead and fix that. But absolute pleasure to chat with Adrien. Next up, we've got Shehram. Let's go ahead, bring him up, and we're gonna be chatting about Trust Wallet. Shehram, welcome to the show, man. Pleasure to have you.
Hey, thank you for having me.
Absolutely, man. It's your first time on the show. We've been friends with Trust Wallet here for a while, and so I believe you're coming at us from London. How you guys doing on the other side of the pond there?
Yeah, really good. Thank you. We're just celebrating the integration of Hyperliquid, so that's
Beautiful.
something that's going on today. But otherwise, yeah, it's pretty good.
Very cool. And so tell us a bit about the Hyperliquid integration. Is it full-fledged? You got every asset at your disposal, all within the Trust Wallet interface?
Yeah, exactly. So we've gone for a full integration, so our users will have access to the whole suite of assets available in Hyperliquid. Very
cool, man. Well, I'd love to understand a little bit more about the broader strategy. You know, when you guys are starting to incorporate more of, you know, some of the distribution channels that are available for assets, you bring a lot of that deeper into the stack for Trust Wallet. You know, we've debated a long time, fat application thesis or fat protocol thesis. And it seems like the sweet spot is a fat wallet thesis, which everyone loves a fat wallet, right? And so, you know, what we found is that those who own the user, those who own the relationship with the end customer, that is who ultimately is able to, you know, kind of monetize first, but then also serve them the best. I'm curious for you, is the goal to build this financial super app? Like, is that the ultimate goal, and then ultimately provide everything that you can, everything under the sun to your users, or how do you think about this?
Yeah, I mean, there's quite a lot there to unpack, to be honest. It's you've got, like, I think crypto's definitely moved from the different theses that you've mentioned. So you've got the fat protocol thesis, the fat app thesis, the fat wallet thesis is something that obviously is close to our hearts. We see ourselves as a interface technology provider, a neutral platform. So in that respect, it serves our interests to integrate with as many crypto applications as we can. So in that sense, you're absolutely right. The aim of the game is to get sticky users, and be able to give them access to as much of Web3 as possible. And now increasingly, as our worlds are colliding and merging over the past couple of years in particular, we're seeing this cross into the Web2 arena as well. So we've got now applications that are coming in from Web3 and then going into Web2 and vice versa.
Yeah. And so what does that look like as you guys enter the Web2 world? Because, you know, obviously this has kind of been the talk of the town, has been the convergence. It's been, you know, okay, we're going to unlock a lot of the internet of value. A lot of these fintechs are now going to get access to ultimately provide a lot of these permissionless financial services that we were, you know, iterating on in the Web3 world. It feels like now we kind of we don't go backwards, but we try to bring the best of both worlds, right? Like, what is it from the Web2 world that really sticks out to you that you want to incorporate into the entire Trust Wallet stack?
I actually really liked the way that what you said there about kind of we're not going backwards. We're trying to get the best of both worlds. I do think that there's something there. Like, you know, if I think about why I joined crypto, and I think some of the people in crypto would be looking at our sector as like almost like a counterculture movement. Yeah. And so they may be looking at the entry into of TradFi and thinking, oh, this is not what we wanted. There's a whole kind of stream of our culture that does talk like that, and I think the way that you phrased it, the way that you're thinking about it is exactly right. It's like, well, what can we borrow from Web2 and the incumbents in the financial sector and learn from them. I think crypto is the the philosophical principles that stand underneath crypto are principles of freedom, self-custody, decentralization feed into that, and ultimately self-sovereignty. For me, we should try and maintain that with the crypto culture. Then borrowing from Web 2, I guess it would be things around, to be honest, we have to concede, like there is a robustness in the infrastructure that they've built out. They've had longer, for sure. But my background is in banking, and I'm familiar with how big banks operate and the processes, procedures, governance frameworks that they've put in place. I think there's a lot that we can learn from what they did, if at the very least learn how to navigate and coordinate a mass market, which I think we are now. I think crypto is no longer a niche. It's definitely mainstream.
Yeah, and I've always liked to say, I mean, it feels like blockchain is the mass coordination tool. This is the mechanism that coordinates not just humans, but also agents better than any other technology because of its trustlessness and its rules that it's been able to codify. There's no referee. There's no central party saying this is good, this is bad. This is what it is, and it is just the ultimate arbitrator, and it's able to coordinate people and users and actors in such a way that is just entirely fair. Now, you guys have been able to amass 220 million human users. I think I'm getting that right. And so I'm curious how you prepare for what a lot of people are thinking about as the next wave of users, the AI users. We don't have to go too deep into this rabbit hole, but it feels like every company has to have an AI strategy these days. Now that you've been able to build out such a network of human users, how do you start to augment, machine to machine? Is it agentic commerce, agentic payments, probably how it starts. Then you have agentic commerce. You just kind of slowly open this up. It feels like at a certain point, I'm just going to use my agent for everything. I'm going to be on a phone call with my agent. Hey, go trade this perp on Trust Wallet. How do I start to interact with the on-chain economy in an agentic first world?
I mean, yeah, I guess to be honest, that's $1 million question, right? Like if we had the answer to that, then we would have probably solved a lot of things by now. I think I don't mean to put you on the spot here, but I guess what I'm trying to get at is, kind of coming back to the fat wallet thesis, right? Like you guys own the relationship with the end customer right now. It's not, people thought it was going to be the apps, then they thought it was going to be the protocols. You don't want to lose that moat, right? And it feels like if people are using their LLM terminal, just a chat bot, in order to be their interface into the on-chain economy, well, where does the wallet layer fit into that?
Yeah, I mean, again, good question. I think that if you think about some of the work that the sector has been doing in terms of abstracting away problems that users have in interfacing with different protocols, different blockchains, bridging, and all sorts of things, AI doesn't care about that. AI doesn't care about the UI layer. It doesn't care about the colors you use or that kind of thing. So it can be as complicated as you can make it, and as long as the AI has a way to navigate through your system, you're fine. So it's definitely a different mindset in terms of thinking about how agents will interact with wallets and how users plus agents will interact with wallets. I think you're going to have layers. I think that the way that we're going about this is in a mindful way, for a number of reasons. I mean, you're talking to the general counsel of Trust Wallet, so there's obviously some guardrails that I'm going to be putting around the business and what they can and can't do.
Understandably.
The fact is, though, that just like any emerging technology, it ebbs and flows. We saw this happen with technology back in the 2000s. We saw this happen in crypto. We're seeing it happen with AI, where there's a stage of euphoria. People think that AI is the answer to all things, to all people, and can do anything and everything. And then the whole kind of edifice breaks and comes crashing down. So there's an element of that, where at the minute, we're talking about things which seem literally incredible, and we're mindful of where AI, the potential of AI, but at the same time being practical. So we have a what I guess you'd call a research and development function, which would be looking into many things around what AI is capable of doing in the future. So that'd be kind of the innovative layer, and that would be looking at what the world would look like if you had agents just doing everything and users pretty much just going off and doing their own thing and not really engaging as much as you would expect, as we do today. At the same time, we have a very practical and pragmatic view on what agents and AI is capable of doing. And right now, we think that there is certainly a need to have users in the mix. So it's users, much like how you would use ChatGPT or Claude today. You're not going to just give away your whole life to your agent, no matter how complicated you've made the system. You're not just going to outsource everything to that system. You want to be involved, and that's how I think we're looking at it as well.
Yeah, I mean, certainly it is still very early, and it still remains to be seen. I absolutely, right now, it's just not practical. It's not safe. It's too dangerous to give away private keys, trading accounts, full access to some of these things. People are experimenting. I'm sure you saw, oh, I can make a prediction market bot with an agent and, be the next gazillionaire. I think that thesis fell through pretty quickly. I'm also just curious, as general counsel, like it takes a brave man to be a general counsel for a crypto company. Like, where do you draw the lines? Like, when it comes to some of these things, are you informing, research and development, hey, this could get us into some trouble. When it comes to the hyperliquid integration, like, how do you structure and put some of these deals together?
That's an interesting question, because it really varies. You've got some deals that they're on the face of it, they're innovative, and from a business and commercial angle, they're innovative, but intrinsically you're looking at established established is the wrong word, established regulations. So if you think about the payments landscape, if you're looking at on-ramps, there's from a legal perspective, there's nothing really going on there. Then you look at something like hyperliquid. The fundamental nature of the assets that you're dealing with is something that we're familiar with. So in that respect, you kind of know what you're doing. You can figure it out fairly easily. Then you go into certain other areas, and I think AI is a really good example of this, where that is a little bit more greenfield or blue sky thinking in terms of, well, what guardrails do we want to put around here? These are the types of conversations that we saw, and actually crypto folk are very familiar with this sort of conversation. We had all these. We went through this thinking process when we were thinking about ICOs and what it meant for tokens and DAOs, and trying to really wrestle with securities regulations and thinking through, okay, well, I understand the securities regulations and I understand where they're coming from and what they're trying to protect and what they're trying to do. But at the same time, I think there's something going on here which is valuable and which can actually genuinely have value to society, and maybe we should experiment with it. We should push it a little bit further. I think tokens is a fascinating area in that respect, because you've really got this new mechanism which we're still figuring out, which is effectively how a mass governance system. So if you abstract, if you remove
the securities features, the equity links, and all of that. Ultimately, you have a way of communicating with, and I use communicating in a very broad sense, but you have a way of interacting with your user base. It's a completely different mechanism or methodology, the token system. Similarly with AI, it's a completely different environment where, you mentioned, do we want to give AI keys? Do we want to give them access to our wallet? Well, precisely. What are the guardrails you're going to put around there? You have to think through the worst case scenarios. You have to think through guardrails and an ability to step in, kill switches and things of that sort.
Right.
So we're crypto's pretty good at thinking through this sort of stuff. I mean, we're already seeing conversations happening in the AI space where we're talking about, okay, is this TEE? Is this smart contracts? Is this something else? Like what are the mechanisms that are underpinning, that underlie the AI infrastructure?
Yeah, absolutely. I think, we're going to continue to see how this plays out, because it feels like every week Claude just one-shots another, set of software services. We've also seen how, Google has come out with some things. And so we're just going to continue to see how this plays out on the AI front. I'm also curious because, it feels like the world is it's consolidating as more of these deals get done. And so I take it you're probably up on a lot of the regulation, the SEC and CFTC regulation that's coming out now. As we see more of this Clarity Act, these kinds of things, it feels like, once again, we're going to get kind of like these industry components, these categories, meme coins, and some of these things that don't quite have business models, they kind of get stripped away. Like, they kind of like don't make it to the next cycle. What do you think of kind of the regulation that's coming out now? Who do you think is positioned to be the best benefactor of something like the Clarity Act, or just generally more regulation coming in the space?
I mean, the obvious answer is stablecoins. But I'm hesitating because I'd like to give you a more thoughtful answer. I think there's definitely a tension within crypto, and it's been there from the start, which is there's the obvious infrastructure and technology play, and the utility of the technology that we're currently still developing. And then there's the other side, which kind of goes into the speculative trading, and maybe a better way of phrasing it would be the play side. So people experimenting and doing things and just seeing how far they can stretch the technology.
Yep.
And the culture, which I think is relevant. Like I personally thought the NFT wave was fascinating because people were swapping JPEGs of, sorry, no one shouldn't say JPEGs, swapping NFTs of rock.
Yeah.
And it's just fascinating that people were attributing value to such things. For me, I love philosophy, and so for me it was a really interesting window into how humans attribute value to objects and to things. And I think that NFTs have kind of fallen away, but ultimately the key point about an NFT, which was that it was non-fungible, was quite a unique and important thing, and you're seeing it come through in different aspects of crypto. Again, as an infrastructure layer that you don't really see at the user layer.
Yeah. Kind of picking up on that thread, then, the culture and philosophy of crypto has changed significantly over the years. It feels like it's gotten more mature, it's gotten more institutionalized, and this could have very deep implications to the product of the work and the product of the industry as it becomes more institutional. I'd imagine that it becomes less innovative, and a lot of that innovation might pivot into something like AI. That is what, you know, this industry has been built on. It's been built on free marketism. It's been built on, you know, some of the libertarian ideals of, hey, you know, no one's going to take my money. No one's going to hold on to it. Not your keys, not your coins. You've got to come take it from me. Everyone should be, you know, access censorship resistance, a lot of these things. But then we've got hacks, right? And then we've got, you know, low quality assets. And so we mature, right? We have institutions come into the space. We have due diligence on the heels of Kelp DAO, drift, hacks. We've got more conversations about circuit breakers and KYC and risk controls and freezing assets from stable coins all the way through to Arbitrum, basically just seizing via the single sequencer. And that did feel like the right decision, but it felt like it contradicted some very deep beliefs that a lot of us have had in the industry for a long time. I take it that we don't want to just rebuild the system that we've already have, where we identified a lot of problems. And so, you know, we find ourselves at a crossroads where ultimately I think we do want to bring the best of both worlds together, but we don't want to sacrifice a lot of our ideals. And so I'll just kind of, this won't be a question, but I'll just kind of offer my 2 cents here, which is that ideally we get, you know, a lot of the infrastructure that we've been building for a long time that maintains censorship resistance. We maintain permissionlessness and you know, peer-to-peer finance, but we also embed some risk controls and we get high quality assets. I don't know about you, like I love art. NFTs were very cool. I wasn't much of a meme coin guy. Like, meme coins were funny if they're going up and you get in early, great. It's gambling, sure, but it feels like high quality assets in terms of, you know, both non-speculative like income products could be, you know, treasuries, it could be private credit, as long as these things are safe. It could also be tokenized equities that come on 24/7. We get more markets, we get more information, we can make better decisions on the rails that we've been building for a long time. Just to paint and kind of put a cap on this, the example would be, hey, if we can get, you know, Apple, Nvidia, Amazon, Microsoft stocks into Aave, borrow against them, earn some yield on them, kind of layer on some financial products. It feels like, and we could do that in a permissionless way, it feels like that would be best case scenario. We don't sacrifice our ideals in the rails, but we do get high quality assets. I'm curious, do you think, you know, what is missing from that vision, and you know, where do you stand? How do you react to, you know, the way in which we've been building the rails, the trajectory of the industry, and then obviously the incoming assets from more institutional players?
I think, I mean, I agree with everything you said. I guess the only other perspective that I might be able to add to what you said was around the global nature of crypto. And what I mean by that is the types of things that you described, the transactions or the strategies that you were describing are something which I would say fit quite nicely into first world countries and into established individuals. The crypto does in some ways represent an avenue for someone to play around and achieve something which they may not otherwise necessarily have been able to do. And I don't mean through the hyper gambling of meme coins. Like, I mean, there's an argument of, well, if you're not kind of born into a certain status now, a certain kind of financial bracket now, it's incredibly difficult to move your way up. I think there is a reality to that statement, but that's not what I was getting at. What I meant was the efficiency play that crypto brings to the table is equally applicable in those scenarios. So if I was to remit funds to Pakistan or somewhere else, then there's it's easier for me to do that through my wallet than traditional architecture.
even though traditional architecture through fintechs, like they're doing phenomenal and actually is becoming really easy and very quick, but that was the edge that we always had over the traditional finance world. I think there was a moment last year in particular where I was worried that we were losing that edge, and maybe losing the will to fight. But to be honest, recently I have seen a resurgence, and I don't know exactly what it is, but there's been a few things that have been going on that have just happened at the same time, including a renewed fight within Trust Wallet, where we feel like there is something that we can achieve here, and there is something that we want to do, and we want to be part of this movement in crypto. And I think that for me is the most bullish thing. That for me is something which I think means that we're not going anywhere.
Yeah. I mean, you can also see this in things like Zcash, I think. It feels like the privacy, like these things are, and I had someone say this to me, and it's so simple. Like it's almost too simple, but like it's a good reminder. Someone was like, hey, remember, these are cryptocurrencies. These are cryptographic currencies. And so like Bitcoin, because it's been ossified, hasn't changed at all. Cryptography has evolved. We have ZK and FHE and quantum resistance and all these things. Bitcoin hasn't changed. It's just no longer the best it just doesn't have the best cryptography anymore. How can it be the best cryptocurrency? And I think a lot of those ideals, the cypherpunk ideals, a lot of those original ethics actually do show up in the Zcash thesis. And I think there is still that cohort of people that are here. They still build with this in mind, and they're kind of reshaping the rankings, if you will, where they're allocating when it comes to Bitcoin, Zcash, Ethereum, smart contract landscape. The sort of state of affairs is ever changing. Where do you find yourself within these talks at Trust Wallet? The more conservative, the more innovative side.
Definitely the more innovative side now. We've really, I think we're going through a journey. We have pushed ourselves to be more innovative, more and more on the edge of crypto. I think you'll see that this year. I think you'll see us doing more and more in that space. Ultimately, the position that we have remains as a technology interface. And so for us, it's really about trying to understand these technologies from the perspective of what can we make available to users, and otherwise it's users interacting with them in a self-custodial manner. Yeah. So yeah, thinking about the privacy coins, thinking about privacy first transactions, and again, it's a similar sort of thought process and framework that we have in place for the AI space that we were talking about a little earlier.
Yeah, absolutely. I'm glad you mentioned self-custody. I mean, this is also an important pillar to what we've been talking about here today. Shehram, appreciate you taking the time, spending some time with us today. Everyone can go download Trust Wallet and trade Hyperliquid perps right in the interface, right?
That's right. Yeah, exactly.
There we go. Well, thank you so much, Shehram. We'll see you again soon. Appreciate you coming on.
Thank you. Have a good one.
You too. Thanks, man. All right. That was Shehram, guys. Trust Wallet, obviously one of the biggest wallets in the game. 200 million plus users. Pretty insane numbers that they've put up over the years. They've been around a long time. Very cool to see them continuing to build. Now, Hyperliquid is integrated. And so the word is Hyperliquid. There's really not much more to say. You guys can go trade Hyperliquid perps there on Trust Wallet. We really appreciate Shehram spending some time with us. Our next guest is coming up in just a moment. It is going to be Patryk from Serotonin. Patryk is the head of research at Serotonin. His Twitter is SoloFunk. It's a pretty baller Twitter handle. It's pretty cool. We're going to be talking about the state of on-chain credit. These guys, they launched a report. They also launched a on-chain credit market map, which is very cool. And so we're going to be talking all about this. Let's go ahead and bring Patryk up, and we'll get into the state of on-chain credit. There he is. Patryk, welcome to the show, man.
Hey, Robbie. Thanks for having me.
Absolutely. Head of research over at Serotonin. What has it been like just internally at Serotonin over some recent months before we get into this state of on-chain credit report?
Yeah, it's been great. First off, I want to say fan of the Rollup since the pre-Neo Finance days when I was
thank you, man.
Nerding out about layer 1s, layer 2s, interop, and all this. But yeah, joined Serotonin as director of research 2 months ago now, and have been heads down working on this state of on-chain credit report. Hard launching Serotonin research with it going live. A lot of our partners work in the space, so we wanted to put in the work, map the entirety of the space, and put out a killer report, what we believe is the most comprehensive one out there on-chain credit.
Epic. Well, it's very, very cool to see. I see, you've got a hitchhiker's guide to on-chain credit, and then you've got the state of on-chain credit report. Are these one and the same?
Similar, totally different content. So the thing is, with this research, we made a market map with over 165 players spanning on-chain credit across 4 broader categories. Those are credit issuance, capital allocation, infrastructure, and risk management. And so the article basically explains our methodology, our mental models for each of those 4 categories, and then 19 subcategories within them, reasoning for inclusion. And then the report dives deeper into data and different insights across the stack.
Very cool. And before we dig into the report itself, why don't you just give a quick shout out? Where can people find this report if they want to follow along as they listen here?
Yeah, I would love to have you guys check it out and hear what you guys think. Very easy to find it. You just type in se.ro on your mobile or your desktop, and it should be the very first thing on the top of the page. So se.ro. Beautiful.
All right. Very, very cool. So we are going to get into the state of on-chain credit. Just got a couple of stats here that I want to talk to you about, Patryk. I see that the on-chain credit market grew 22x to over $5.5 billion in 2025 amid 300 billion plus in stablecoins. Has this been the primary driver of growth in on-chain credit? Has it been a result of the stablecoin boom, and then now we're starting to build out kind of the economic functions around stablecoins?
Partially. So what's leading it is the yields that on-chain credit offers. But I'll take a step back in terms of the on-chain credit growth. That's a 22x increase in 2025. Real world assets, as you know, are growing at a rapid clip across all of the different asset classes within RWAs, but on-chain credit was the fastest growing one outside of stablecoins in 2025. So rapid growth, and what on-chain credit is doing is introducing exogenous yield that's uncorrelated with the broader crypto markets. So, historically, money market activity and just crypto in general has been kind of siloed depending on the broader market 4-year cycle and all this. But on-chain credit is bringing exogenous yields that are higher than benchmark rates, like your average DeFi lending rate or 3-month US Treasury bills. And that's consistent with traditional private credit as well, which has grown incredibly since the global financial crisis in 2008, from up to 2 trillion now, projected to grow to 4 trillion in 2030. And it's a similar story there, that private credit introduces yield that is uncorrelated with the broader equity and markets, averaging around 9% yield. And it's a similar story in on-chain credit.
Yeah, it's pretty incredible. I mean, in here you have stable coins, like we said, at 300 billion. That chart's up and to the right. And then we look at private credit, projected to double to 4 trillion by 2030. That's an incredible pace of growth. I feel like people are a little bit confused by private credit. You know, they hear on the one hand, this is adding a lot of assets on chain as we tokenize a lot of these private credit instruments. This is what's driving higher yields. It is exogenous, right? Where, you know, previously you had DeFi summer, a lot of the yields, it was just token emissions and you know, leveraging up rehypothecation until you were so wound so tight, you know, that, you know, yeah, you were getting some double digit yields, but the likelihood of that sustaining over time was very, very low. And so that was endogenous yield back in DeFi summer. Now it feels like we have something that's more sustainable. It's coming from the outside. You know, it's exogenous to the DeFi industry itself. But then on the other hand, we hear quite a bit about private credit that doesn't sound so promising. Can you just help kind of shed some light on what private credit is these days? Are they just dumping private credit on our heads because, you know, it's easy exit liquidity on chain? Or is there like some real sustainable substance to this asset class?
Yeah, there's definitely sustainable substance to it. I think the FUD of the traditional private credit fears in terms of the redemption halts and prices dropping is overblown when it comes to equating that with on-chain credit. Of course, traditional private credit is in a bit of turmoil right now. A lot of funds are halting redemptions. Prices of publicly traded BDCs have dropped up to 40% in some cases. And so to define private credit, it's non-bank lenders, so institutions that underwrite and lend to for a variety of different reasons. I mean, it can be to a company, it can be to finance an asset. And so that is what private credit is. And what's being tokenized, yes, there are some institutional funds that are coming on chain, like Janus Henderson's JAAA or Apollo's ACRED. But there's about 8 or so tokenized institutional credit funds that are on chain right now. So the exposure is pretty limited, and the FUD happening in traditional private credit has not extended in on-chain. In my opinion, it's as of right now, the exposure is quite low. What's exciting from my perspective is the on-chain origination side of things. So a lot of folks may be familiar with Maple Finance. That falls under that bucket, leads the on-chain origination category by extending credit to over-collateralized institutional borrowers. But there's a variety of different protocols that are doing similar things. Figure is, with their hashrate protocol, tokenizing the opportunity to provide capital that is then extended as credit for home equity lines of credit, HELOCs. That's yielding around 8%. There's also the InfraFi category, so financing physical infrastructure. USD.AI just launched their token. A lot of hype around that. Daylight is another one. So there are tokenized institutional credit funds coming on chain, but there's a lot happening on the on-chain origination side as well.
Got it. Okay. And so you're pointing to these, and I'm gonna try to find these on the market map. All right, I see Figure here. All right, tokenized off-chain credit. We've got Figure. It looks like we've got Rockaway X and a couple others. And then you point to the on-chain origination as well. And this is Maple and some of the others that you mentioned here. And so I just want to make sure that I understand the difference here. On the off-chain side, you have someone like Figure. They're going out and they're sourcing demand for credit because people want a home equity line of credit on their home. And then what we're seeing is that we have pools of capital on chain, and then we're drawing from those pools of capital, providing that capital to someone off chain in that case. That's correct? And then, yeah. Mm-hmm. And then on the on-chain side, it's the reverse. We have someone off-chain that is lending to someone on-chain. So Maple sources demand from different on-chain protocols. They might be looking for some sort of credit. And so you have an off-chain company with their own balance sheet. Maybe they've got some cash sitting around. They can bring that cash on-chain and lend it out to someone that is looking to borrow it from Maple on-chain.
You've got most of it. I'll clarify something. So on the tokenized off-chain credit side, you got that side right. So Figure is using blockchain as a vehicle to improve their systems and save costs. So by tokenizing the actual HELOCs, they're able to save about 120 basis points in cost per loan. So that's making their business a lot more efficient. Falcon X and Rockaway X are also extending credit off-chain, and on-chain capital is able to take advantage of that opportunity by lending to them on-chain. So Pareto has vaults where you can deposit capital that then goes to Falcon X and Rockaway X, who extend credit to off-chain borrowers that they underwrite. And then on the on-chain origination side, you are pooling on-chain capital and extending it on-chain. So Maple Finance, anyone can deposit and mint syrup USDC, USDT, and then that capital is used to extend credit, like you say, to off-chain borrowers with crypto native collateral backing that credit. Hastra is similar, where users deposit funds, and that capital is pooled and used by Figure and other HELOC originators to extend credit off-chain. But the pooling of the capital is happening on-chain.
Got it. Okay. Is there one of these categories, one out of the two, that you think are, more poised for growth? Where do you see more opportunities, on-chain or off-chain origination?
I would say on-chain. I'm a crypto native guy. I get excited about the very crypto native protocols, and so that is the biggest category. You see it with 23 different players, and I expect it to continue to grow. There's a lot of exciting protocols out there. On the payment finance side, for example, Credit Coup pooling capital to finance Rain and the credit cards that they are extending. So that's backed by the receivables by folks using those stable coins or those credit cards. Tix is providing financing for event venues, so trying to disrupt Ticketmaster. So a lot of exciting things happening on-chain origination, but really I expect the entirety of this space and this map to just continue to expand.
Yeah, very, very cool. It makes sense. And so would you classify both of these, or I guess we talked about several of these different or credit origination protocols. We talked about Maple, Rockaway X, Figure, Falcon X. Do these all fall under the umbrella of private credit?
A lot of them do. I mean, it's just really a matter of terminology.
Okay.
So in my opinion, private credit is a non-bank issuer or pool of funds extending credit to some entity. That can be an individual, it can be an institution. So really all of this is that. But I think on-chain credit is a more applicable term, just in terms of how blockchain and crypto tech is being used and merged with credit opportunities.
Very cool. All right. So now let's talk about, some more, I guess, of the supply side. Obviously, people are hungry for high DeFi rates. Other tokenized institutional credit funds, right? And so you say here, this is led by Apollo and Janus Henderson. Based on this chart, it looks like Janus Henderson is blowing this away, especially towards the end of last year. It's just a lot of orange on this chart. Their JAAA is just under 3x that of the next highest player. What is it about Janus Henderson that's been able to see so much success with their JAAA fund?
Yeah, so Grow Finance is an agent within the Sky ecosystem that focuses on credit and some other yield-bearing opportunities on chain. And so they had a $1 billion seed investment into the JAAA tokenized credit fund. And that's why you see the big spike there at the tail end of last year for JAAA. And on the capital allocation side, the Sky ecosystem is a major player. Grow Finance, Spark, now Obex are all allocating to different parts of the on-chain credit ecosystem. So Obex, you may have seen, they just announced their inaugural cohort of 8 different projects, many of which are within this map, on-chain credit, USD Maple, many others. And so Obex is now beginning to allocate capital to on-chain credit opportunities as well. On the curation side, You mentioned money market activity, and so this is a massive part of on-chain credit as well. Curators are allocating capital not into investing in on-chain credit, but they are providing liquidity on money markets that enable the productive use of on-chain credit assets. Looping comes to mind, right? If you're able to take advantage of some of these higher yields of, 5, 6, 7, 8%, and borrow against that collateral at 4%, that provides an attractive looping opportunity. And so curators are taking advantage of that with their vaults, offering higher yields for their users and depositors. So yeah, that's a bit about the capital allocation side of things.
Got it. Okay. And let's just hover on this for a moment. The Sky ecosystem, like you said, is a big part of this story. And so the funds deploy these strategies and they list these tokenized funds on chain. And then Sky is effectively just pouring capital into these funds. You mentioned Grove is a big part of this story as well. And so does it make sense, like, Sky is kind of an on-chain protocol. They're looking for on-chain funds. We're just going to continue to see this, if Sky is able to get kind of their, I believe it's 3.75% is their base rate on USDS. They're able to increase the amount of USDS in circulation by issuing this and paying 3.75% yield. Then they're just going to go turn around, almost like the looping strategy that you mentioned. They're going to go turn around and invest that new that new USDS into the JAAA at 5, 6, 7%.
So yes, you're correct that these opportunities power the Sky savings rate, and the hope is that it pushes it upwards, right? I don't know that Sky would be engaging in looping activity. Obviously, that is a riskier activity. And they tend to be more risk off, more conservative. But even if you're getting 5, 6%, that is higher than some other opportunities that are on chain, right? If you just hold the base credit asset without looping it. But I will say that longer term, right now, it is a lot of crypto native capital that's being allocated to on-chain credit, like from the Sky ecosystem. But longer term, I think the benefits of tokenizing credit are apparent when you take into account the composability on DeFi. So it's difficult to borrow against your credit in traditional finance, let alone loop it. And so by tokenizing some of this, it makes it easier to take advantage of borrowing against that collateral, maybe even looping it, amplifying yield. So longer term, I hope that more traditional capital comes on chain to take advantage of some of these benefits that DeFi provides.
Yeah, and it seems like, especially once you start to fit some of these things together, let's just think through the convergence of some of these things, because intuitively in my mind, it's like, okay, all right, one, we have stable coins. This is kind of the backbone of this on-chain credit, financial system. Once we have stable coins here and we have, some tokenized funds, these stable coins can start to earn some yield. And then I can imagine some traditional players coming in. They're looking to earn that yield, and then they can turn around and they can originate more loans, almost like you would do in like an Aave Horizon, borrow against your credit in that sort of sense. But they can do this at much larger scale as more of these facilities come on chain. When you start to see the convergence of, the on-chain credit origination, off-chain credit origination, as well as these tokenized funds, what are some of the use cases that start to come to mind as you see these protocols fitting together?
Yeah, that's an exciting long-term vision and potential of bringing actually the broader origination process on chain. I think that's still a ways out. There are some players popping up that are trying to bring the entire credit origination cycle on chain. Valinor comes to mind, just raised over $20 million to re-architect the origination process using blockchain technology. Rialo is another one, creating a purpose-built blockchain that focuses on credit and some other real-world asset opportunities. So I think that's further out, but there is potential to bring the broader origination, underwriting, loan repayment process on chain. I just think it's a little bit further out.
Yeah, makes sense. Another thing I want to cover here with you, there's been some debate on chain about where yields are. Too high, too low. People have been saying, look, why am I going to deposit into some of these DeFi protocols at 3, 4, 5% when treasuries can give me the same thing? And I'm taking way more risk in these smart contracts. I see you have another chart here, on-chain credit yields well above the 3-month US Treasury rate of 3.7%. And so you've got ACRED here at, upwards of 8%. You've got more funds on here spread at 8%, 7% for some of these other ones. JAAA is at 4.8%. Even that is higher than treasuries. Is DeFi dead and it's long-lived neo-finance? Like, is this the future of yields on chain? We're going to be looking at these, on-chain tokenized funds from Janus Henderson and Apollo, between this 4 to 8% range. That gives us, plenty of edge beyond treasuries. And, in theory, we are getting more protection than something like Kelp DAO, where we just saw, quite an exploit. Like, is this going to fuel more adoption of these? Where do you think DeFi yields go from here that aren't currently offering, the safety protection or the higher yield of these tokenized market funds?
Yeah, yields fluctuate. I think DeFi rates will trend upwards over time as things get better, just in terms of the market. But the way that I end the report is talking about traditional finance coming on chain versus the on chain, the opportunities and the values of permissionlessness, of broadening access, things like this that we all came into crypto for. And I think it's going to be a mix of the two, where yes, you have institutional credit funds or institutions coming on chain to take advantage of some of this capital that is on chain, broaden access for their products and increase their AUM, right? I think that's totally valid. And those assets will likely remain barred for KYC accredited investors with significant investment minimums. And I think that's fine. It does stand to push yields up where, if there's money markets for those assets as collateral, if you are lending to that market, you also take advantage of the higher yield because the borrowing rate is higher than maybe some other crypto native collateralized markets like CBBTC. So I think that's fine. And then on the on-chain origination side, this is where it's exciting for me because some of these opportunities, access is broadening for them. Anyone can go buy Syrup USDC, buy Maple, and be earning that 4.8% yield, or Prime, buy Figure, and earn the 7% yield. So there is a lot of exciting stuff in the on-chain origination side. And what's cool is that it broadens access to folks like you and I to easily gain access to some of these yields where we wouldn't otherwise be able to access them.
Yeah, it feels like the biggest loser out of all of this is going to be the traditional bank savings account, because that's where a lot of people have their money parked. Even in an investment account, you can go stick it in a money market and you can get, 4 or 5%. Like you're saying, that there's higher yields available, the 8% from Janus Henderson, the 9% from Figures Prime. What's cooked is the, basis point and a half that I'm getting from, a savings account in a traditional bank. That feels like it's long gone.
Yeah, totally. And I think that's what we all want. When I was younger, my dad would put some of my savings that he was managing for me into CDs that yielded like less than 1%. And then I studied finance in university and I realized that that's crazy. So yeah, and you're seeing a lot of fintechs now get into this on-chain space. Kraken has vaults with Veda, allowing their users to take advantage of some of these on-chain yields. I fully expect other larger fintechs, kind of Web 2.5, if you will, to start offering products that allow access to on-chain yields in a very easy way through their front ends. So yeah, I expect the access of these opportunities to continue to accelerate Even if you're not willing to go on chain yourself, you'll probably have access to them through some of these apps.
Yeah, that it certainly looks that way. Where someone, a retail user, is not going to be sophisticated enough to do due diligence on Apollo, Janus Henderson, Acred, JAAA. Like, they're not going to go down the entire stack of these different products. They're going to pull up their financial super app, where they have, invest and earn and save and spend and all these things. And they might get a few of these suggested to them. You can also see how finance becomes like an algorithm, like a social media feed. And you're just kind of scrolling. You're like, yeah, I like that one. I like this one. And then this is, you've got a For You page for private credit. And this is ultimately where we get a lot of our investment access from. And we just get it served directly to us.
Totally. Yeah, the vault curators, Steakhouse and Toro, all of them, they like the sound of that.
Yeah, we're going to see a For You page from the vault curators here very soon. Patryk, man, I appreciate you spending time. I just got a couple more like general questions here, I guess. Like, as you were building through this, you took a lot of time. It's obviously a very thoughtful, well done report. Did a great job on it. I'm curious, from your perspective, what's the most surprising thing that came out of this? Like, did you have expectations going in? What happened to those expectations? Did it kind of line up? You just were able to level up your own understanding, or did anything catch you off guard? Anything surprising?
Yeah, I was very excited to jump into this research and this report, similar to your neo-finance thesis. Traditional finance is coming on-chain and merging with on-chain DeFi systems. That's a thesis we have here at Serotonin as well. Learned a ton throughout the 2 months working on this report. I think the on-chain credit space is much more expansive than I had imagined in the beginning. I knew about Maple Finance, but there's so many other players that make up this stack, not only on the credit issuance side, but also on the infrastructure, capital allocation, and risk management side of the stack. So it's huge, and it's only growing. That's one big surprise. Maybe the other I'll call out is the growth of on-chain credit, 22x in 2025, and the fact that every single on-chain credit asset that I looked into was yielding above 3-month US Treasury rates and average DeFi lending rates. So that just shouts the yield opportunity that on-chain credit presents.
Yeah, which it certainly should be. I mean, look at there is an additional risk here. Yeah, so we've got to take that into account. And I guess similar question, but did you notice any dislocations? Like, and just, I mean, from a quick look at the report, it seems like Janus Henderson, 8.2% is a great yield, very reputable company. Seems like a good place to lend there. And then when it comes to borrow, like, did you notice any arbitrage opportunities or any significant dislocations in some of these lend borrow facilities?
If you're saying dislocations versus the borrow rate, there are definitely several, and that's why a lot of looping activity is happening on some of these assets. Just highlighted in a thread today, Falcon X's vault receipt token from Pareto, that is yielding around upwards of 9%, and you can borrow around 5-6%. There's a lot of looping activity happening there. I only expect that to continue. The one thing holding that back is the liquidity side of things. Private credit, or credit in general, is a longer duration asset class. So investors have to be willing to hold this thing long term, and there are opportunities to get out. Many institutions allow up to 5% of the NAV of a fund to exit every quarter, but that still takes a quarter and is subject to the cap. So the problem with DeFi is that everything is built to be instantly composable. You can take your money out whenever, move it around, and that doesn't really work with some of these on-chain credit assets. So liquidity is really holding back the looping opportunities. There are a lot of liquidity protocols like 3F, Fission, Quark, that are helping to solve that problem so that on-chain credit can be used and continue to scale.
Yeah, and man, I think this is just expansive. I guess not much else from my end. Everyone, guys, go check out the State of On-Chain Credit report. Patryk did an incredible job on it. se.ro, that's Serotonin's website. You guys can find it there. Patryk, I'll give you the last word. Any closing thoughts here? Just, wrapping up the state of on-chain credit. It feels like this is just still extremely early. There's a lot of players coming in, and the market is going to make sense of it here over the coming months.
Yeah, coming months, coming years as well. I expect it to continue to grow. I'll be keeping up with it, posting about it on my X, and we'll just end by sharing that this is the hard launch of Serotonin research. We're going to be working with partners in the future to put out research alongside them. So if anyone is interested in that, feel free to reach out to myself or Serotonin. Would be happy to jam with you guys on some future research, and hope you, Robbie, and everyone else in Miami, I'll be down there.
Yeah, let's do it, man. The Neo Finance thesis lives on. Let's collaborate on something real soon.
Let's go.
Cool, man. Thanks for coming on. Big congrats to Serotonin Research. And Patryk, thanks for coming on, man. Appreciate you spending the time. And great report.
Robbie. Appreciate you.
Yeah, we'll see you soon. Cheers, buddy. All right, guys. The show continues. Great report. I mean, this is comprehensive, to say the least. Just looking through it now, I mean, Sky's got an entire section here. Patryk went through vault curation, traditional private credit, talked about the on-chain origination, off-chain origination of a lot of these things. Transparency is huge. The verifier network, Chainlink is mentioned. Very, very comprehensive report here. Would suggest you guys check it out, because this is a pillar of Neo Finance these days. I mean, this is what DeFi has become. It's become this entire web of interconnected financial and credit products. And this is not slowing down. This is actually accelerating. I wouldn't be surprised if we see a significant portion of the top 20, 50, 100 coins out there to look a lot more like, you look at like Figure HELOC, which I believe is something like in the top 10. Yes, number 9 right now. And it's just slow and steady. It's just basically a stable coin at 103. But then you look at Superstate, they've got a treasury fund, government securities fund, USTB, and it's just up and to the right. So it's pretty incredible to see the growth of these products. And I do believe that, this is going to be the pillar where now we're going to get a lot more functionality mechanisms built around it. Feels like this is DeFi in 2026 and beyond. So we're going to see a lot more of it. Guys, next up, we've got Lasse Clausen. I hope I'm saying that first name right. Founding partner at 1KX. We're going to bring him up. We've got friends at 1KX, Peter and Wei. These guys, we go way back. First time having Lasse on. Welcome to the show, man. It's a pleasure to have you.
Thank you for having me.
Yeah. Well, like I was just saying, Wei is a friend of the show, as is Peter. I think Peter was actually in our Empire State Building office yesterday. He was just paying my co-host to visit there. And so we go way back. You guys are doing incredible things. It's the first time on the show. I'd love just a introduction to yourself and how you ended up finding 1KX.
Yeah, again, thanks for having me. Also, I'm a big fan of the show. And
Thank you, man.
yeah, my background is I was an entrepreneur together with Chris, who's the other founding partner of 1KX. And, we've really been in the trenches for years and grinding it out as entrepreneurs. And originally actually looked at blockchain at the end of 2016 to build companies on top. So this could be a new platform. This is a new internet of money. Can we build companies on top? And then, we realized pretty quickly that it's a little bit too early for, let's say, an Uber on the blockchain. If you remember those days, you basically had Ethereum and ERC20s that you could send to Binance, and that was kind of it. Even Uniswap, all these things that we now are sort of old DeFi, etc. None of that existed yet. But for us, it became clear very quickly that this was going to be very, very big. And we wanted to be part of the space. And then, looking at the investor landscape back then, it was very immature, to say the least. And most importantly, there weren't funds that were run by former entrepreneurs. And I think we've seen a venture as well that for early stage software or tech investments, former founders do tend to be better investors. I've obviously tried to think about this a lot. And I think the main thing is because when you're an entrepreneur, you're always 2 bad decisions away from killing the whole thing. I mean, really, the pressure is intense. And so you develop this laser focus on what to worry about. And this is actually really hard. It's hard to know what to worry about in the early days, because we would have investors that were very smart and very thoughtful people, and they ask us all these very complex questions that completely didn't matter. And so I think what you can bring to the table when you're an investor as a former entrepreneur is that you actually know what matters in those early days, and you just try to help with that, and then everything else you kind of get out of the way. Long story short, we really set up with a very authentic and genuine vision to just be entrepreneurs with money and support other entrepreneurs going through these difficult journeys. Again, if you think about it, when you're an entrepreneur, it's most of the times you don't have a girlfriend, because on the weekends, people go to brunches and parties, and you're going back to the office. People invite, your friends. You kind of end up having not any friends because they want to go on skiing trips, and you're like, I have to go back to the office. I can't, fly down to Austria on the weekend and go skiing. And so I think that's a big part, that as a former entrepreneur, you really know what it really is to be the journey of an entrepreneur, and relate to that, and then just try to be as helpful as possible.
Yeah. Yeah. And so I'm curious just to dig in here. And I think it's important, the audience does get a little bit of background on yourself. You've, built and led WeRide, which was a daily ride Berlin-based mobility startup. And so, you've had trials, tribulations here, as the entrepreneur. In your experience, right? You mentioned, you're going back to the office day in and day out. What are some of the things, maybe we can just get a couple of examples, something that comes to mind. These founders are asking you questions that don't matter. Like, what are founders obsessed with that you think just does not matter? And then we'll get to the opposite. What are they not thinking about that you have to set them in the right direction?
Maybe a quick edit there. I meant to say that investors, they ask you these very thoughtful questions when you're an entrepreneur, right? So we were entrepreneurs. We had investors, incredibly accomplished, smart people, asking us questions like, this question, what if Microsoft does this? And, we are basically, I'm struggling to have 3 customers here, trying to, figure out what I'm building for them. And I don't need to have a 2-week email conversation about what if Microsoft does this, right? So that would be a very, very specific example of investors. And I think it's not incorrect to think about these things or have that in the back of the head, but also if you're just trying to get product market fit, I think what would be more helpful is really like, hey, what are the metrics do you think that matter, right? That help you find product market fit, that even help you know, do you have product market fit? I think those are the things really that as an entrepreneur, you basically, you want to find customers that stick around, and you want to make sure you don't run out of money, right? I don't need to philosophize about what if Microsoft touches this, because right now it's 3 customers and I don't think they're coming for us just yet.
Yeah, absolutely. And so, I mean, I guess the previous question is still remains, when you're helping to direct early stage founders, what is it that you're looking for? We have a lot of VCs on the show, and so everyone seems to have a bit of a varied answer here, but I'm curious from your perspective, what is the general thesis as you look to deploy capital into the next generation of founders? Who are you looking for, and what are you looking for in these founders?
Yeah, and so we have, we refine it, because we always come back at the end of the day, it is really the entrepreneurs that make the difference. It's very obvious in hindsight, but it's remarkable of how many times that in practice is more difficult, because also they come sort of, we have about 20, 25 variables that we really rank founders on. I think one note also here is that this has changed over time. I think generally in digital assets and blockchain crypto, even just like it used to be crypto, now then it was blockchain, now it's digital assets, right? The industry is evolving, and the founders that are relevant are evolving. And I would even go, I think maybe a good example for that is like Vitalik, I think, had a time where he was the perfect founder evangelist for Ethereum and for the industry, right? When it was really about attracting very, very innovative, very creative engineers that are sort of looking beyond, and that, are willing to fight their way, through Solidity, not the best programming language, etc., but that need sort of an ideology and evangelism that attracts them to experiment around this with really, really big ideas on how to change the world. I think there was a period where Vitalik was really the best evangelist in the world. And now I think as we're getting sort of, the infrastructure level is mature, and now we have to attract founders that are a bit more, sort of classic entrepreneurs that are revenue driven, that are, IPO driven. I think there you have, a different kind of entrepreneur. So at the beginning it was very evangelical, very, very technological. Now we think that, particularly on the infrastructure layer, the technology has broadly sort of been played out. And you don't need a cryptographer that is a great Discord evangelist. Now you need entrepreneurs that know how to do business development, that set up sales organizations, right? That need to know how to make friends on Wall Street and distribute products there. So I think that is maybe the common thread is evangelism, the ability to get people excited about your vision and your product. But in different shapes and forms, right? In the early days, it was more quirky. It was, colorful unicorn T-shirts, very sort of ideology driven, and I think now still that ability to get people excited, but it's a different kind of people that are more important now, and you have different means of communicating with them. But I think the common thread really that goes throughout is entrepreneurs that have a strong communication ability, that are able to get people really excited. And get people to drop everything they're doing and move halfway across the world to join them on their vision and work on what they're building.
Yeah, absolutely. We've seen a lot of this as well. We've been calling this like a show me the money market right now. It feels like business plans, I mean, obviously are very important, but for a while there, it was like you could just, put together, we're going to be a faster, cheaper L1. You'd get funding, you'd able to launch, you'd do the whole thing, and you would end up making money, unfortunately, because it wasn't really a net positive add to the entire industry. It feels like now, like you're saying, the value edge is at, committing, driving together a business forward, putting together some sales, getting real users, real revenue, and making sure that business plan is sustainable. Lasse, I want to ask you a question. It's not like a gotcha. Because I'm sure that there is a consistent rationale and investment thesis. I noticed you guys did this company called Giggles. And so in a show me the money environment, we're talking about putting together business deals, and it feels like it's just like a more serious environment than the rainbow unicorn T-shirts of, 5-7 years ago. How does a company like Giggles fit into the market conditions in today's day and age?
Yeah, it's a good question. I think the short answer is that the ability to drive attention and to consistently generate attention and consistently keep it and funnel that into a product is priceless, particularly in an age where your product and coding is almost commodity. Any good product manager now that knows how to use Claude can create products and technology. And so we do value also on the consumer side and teams that have shown this consistent ability to generate attention and market in an unconventional way and get particularly young people's attention. So that's the story behind Giggles. Yeah.
Very cool. Yeah. Okay. So another part of this thesis, attention is effectively everything. We've seen those who own the end user relationship. That is who is able to effectively monetize first. Everyone else is further down the value stack. And so, in this day and age, Claude, AI, these things are commoditizing tech. Again, is distribution, is it the most important thing right now as you guys are thinking more in terms of the companies that you're prioritizing? If you see someone who's, maybe, they're thinking a lot about building a net new product, but they're not thinking about go-to-market or distribution as much, do you help steer them in that direction, focusing more on acquisition and more on distribution?
Yeah, and I think we have, sort of the industry kind of overcorrects or is focused on one area too much and then sort of overcorrects a little bit. It also depends, obviously, where in the stack, you're investing, where in the stack is this project or company. But definitely on the, let's say, company side, where this is clearly like you need to have a product market fit, you need to be solving a real problem, you need to, demonstrably show that people are willing to pay for the solution of their problems, right? Which is the solution is your product. I think there is definitely a strong focus again, and we actually don't see that it's something that you can really change. So it depends again on the stack. But if it is something that really is trying to sell on Wall Street, and you have a founder that's more comfortable, turning the video off in a call, it's probably not the right fit.
I see what you're saying. Absolutely. Yeah, I mean, we are. It does feel like we're past the anonymous culture, meme coin kind of surge, that whole thing.
I'll say I've never bought into that. I know it was a thing for a while, and I thought, this is essentially proof of stake, your social capital, that people know what you're doing, and we are removing that stake completely, and I can just be an anonymous founder and basically raise money and run away, and there's zero consequences for me. So I hate to be the I told you so guy, but I never bought into that. But it was a real big thing for a while, and now I'm kind of thankful it didn't stick around.
I mean, look, you got to be contrarian sometimes to survive, this long. And I take it you didn't get burned in the ICO wave of 2017 too much, because that was happening quite a bit back then.
Yeah, I think, we see this in variations. So I think it's really a testament to how powerful this technology is, that, money can flow around the world 5 times in 20 seconds. And so we always see the ability to raise money in, massive amounts of money. And unfortunately, this is the price we pay for permissionless innovation. You also get a lot of people that are very crafty and just give me the money, and then, I'll basically run away. Or I've heard of projects that basically pre-wrote 5 years of product updates or project updates.
Five years in advance. They just schedule those investor updates out. Yeah, no, I mean, I'm not surprised, unfortunately, because it has been a very buzzwordy, ecosystem as of late. Now I feel like a lot of those people have gone into the AI world, and we're still here. What do you think are some of the sectors most poised for success? I mean, I just got off a chat with Patryk from Serotonin, put together a state of the on-chain credit report, speaking about on-chain origination, figure HELOCs. There's all kinds of opportunities here. It feels like there's more businesses out there that have established businesses that are now adopting blockchain technology. Do you see a lot of value in, net new applications, or do you think, look, it's time, we kind of stick to what we know best, and we're going to use blockchain to scale it? Where do you think is some of the largest opportunities still at play?
Yeah, I think that's a very careful balance. I definitely, we may see some people that are sort of overcorrecting into that convergence of fintech and DeFi and kind of blockchains. Don't get me wrong, I do think this is really the most imminent after stablecoins, it's become very obvious now that this is massive, and it's basically upending one of the most important layers of the economy, which is payments. And, this after years and years of hearing we have ACH, it's great, I don't need stable coins, or I don't need a blockchain. And it turns out that actually this is a 0 to 1 or a 10x improvement on payments, just the fact that it's programmable, it's 24/7, it's almost at zero cost. And then obviously the next easy, I think, sort of extrapolation is, and Larry Fink from BlackRock is evangelizing this for years now, is basically that you run the financial system on blockchain rails. And this is, I'm not saying anything too crazy or new here. I think there's large consensus that this essentially this transition of finance, and I'm not just talking about sort of trading, etc., the financial system, but really the finance of everything. So corporate finance, etc., banking, payments, etc., moving on chain. That's a very, very clear, big, obvious sort of massive application box, let's say, or ecosystem. And that will be very, very big. I think there's also the risk to kind of miss out what is coming sort of after that. Even though it is not as clear, not as tangible. We are actually seeing that RWAs, tokenization, the world of finance running on blockchains is so obvious that in the lens of many LPs, before it used to be crypto VC. We need a team that understands this black box of crypto VC, and they're specialists. And there's very few LPs that made the effort and dedicated to understanding this, or had advisors that helped them allocate, and they did extremely well. What we're seeing now is that there's this massive new set of VC LPs that are saying, well, okay, now it's just part of VC. It's so obvious that this is, happening, that basically the tokenization of everything is happening, and it's not an unclear use case anymore. It's very obvious, and we're just putting this basically in the VC bucket. At the risk of that, I think there's a bit of the risk of sort of over focusing on that and missing kind of the bigger things beyond that. We have, just for context, so our guiding North Star, the thesis is why blockchains, why do I need one, is called cost of trust. And so what blockchains do well is that they manufacture trust at almost zero cost, right? And so trust is it's omnipresent, but it's also very abstract. But it does affect many, many other areas of the economy. And in some shape or form, that will be ripe for disruption. There's a way to extrapolate. There's a paper that said that 35% of US employment is trust establishing functions, right? Auditors, notaries, attorneys, etc. So that kind of gives you a rough idea if you were to extrapolate that 35% of the economy is cost of trust. And so it goes beyond that, but in some ways it's very abstract and unclear yet. So I think there was this whole movement of like social media on the blockchain. Right. And we obviously monitor very, very closely. We thought it was a little misguided. It was too skeuomorphic. It was like, oh, we'll do Twitter, but on the blockchain, which turns out that now it's kind of just worse. But I would say that there is mass amounts of trust involved, right? For a whole society to rely on a social network to convey truth or not. That's actually a big trust factor. And we've seen in the case of Facebook, for example, right, where they made politics. They basically decided an election by deciding to withhold or suppress a story. Yeah. So there is a massive trust factor here at play. It's just very abstract and kind of unclear how that is going to transform into, let's say, blockchain-based product, right? So I'm just saying that I think we have very, very big, very clear use cases, such as finance or the financialization of everything on blockchain rails. There are other things beyond that where trust is very expensive, or it prohibits actually some use cases. Then there's also DePIN, which is actually very interesting. It's the fastest growing sector in terms of fees by far. And I think the general way to look at it is that you have marketplaces, and then blockchains are just really, really good at organizing supply and demand, coordinating that, and then basically an accounting layer for work that's been done and a payment layer, right? And that's all automated. That's almost at zero cost. In the middle, it's just a protocol, not a company coordinating that anymore. So that would be also another use case where you decentralized physical infrastructure. That also has a very, very strong blockchain use case. And then we have obviously this massive AI, crypto plus AI. Mm-hmm. I think that's also been unfortunately a little bit abused in this industry, where you had a lot of projects that were sort of, I think harvesting the excitement from the retail investor to get in on AI, because, I can't invest in OpenAI, I can't invest in Anthropic. But we do think there are, an agentic economy is going to be massive. It is most likely going to run on blockchain rails. It's not going to be on ACH that shuts off on Friday at 5 p.m. But I think the ways to invest there are not as obvious. In our case, they're actually more specific.
Very cool. And so there's quite a few sectors that you had mentioned there. It sounds like DePIN is one of the fastest growing. You're also, I think this is probably contrarian take. I mean, you mentioned that you're still looking forward to some of these non-financial use cases on chain. I think this is one thing that a lot of people have pretty much written off after the collapse of NFTs. They've seen, Farcaster was kind of that, on-chain social program, didn't really work out. And now we have some of the largest financial institutions in the world talking about tokenization, talking about coming on chain. You mentioned Larry Fink. A lot of this ends up on chain. People have kind of put a lot of the opportunities aside from finance. They put it in the back of their minds, really as maybe something that comes up, maybe something that never comes up, but it still remains to be seen. Before we let you go, I want to ask about the VC landscape in general, because it feels like we've got sort of a divergence, a bifurcation in the VC landscape, particularly within the crypto industry. A lot of the companies that are now benefactors of the power law, we see this across, the entire stack. Prediction markets, perps platforms, prediction markets to Kalshi and Poly market, runaways. It feels like no one's ever going to catch them. hyperliquid, and you can even say lighter, maybe Aster in there. Runaways when it comes to the perps platforms. It would be very difficult for someone to catch up. Maybe it's possible, but it might take a long time. And it feels like even, DeFi, you've got Aave, you've got Morpho, the power law suggests these will continue to lead. And so as these protocols, the ones that have gotten very lindy, continue to do well, it feels like if they raise more capital, it requires larger funds. Maybe they even go outside of crypto into traditional finance or technology funds. They raise larger checks. They go into later stages. And then on the other side, you've got maybe very early or maybe nothing at all when it comes to how AI is augmenting some of the early stage companies that are out there. It feels like it's becoming more difficult to play the VC game. At least this is maybe what we're hearing from people that have been on the show. Do you think this is the case? Do you need to write larger and larger checks to keep up with the pace of the industry and therefore raise larger funds? And if so, are you seeing the demand? Generally, is this trajectory, does it resonate with you?
No, to be honest, it does not. So the first is that, we issued an on-chain revenue report to really sort of dive into the concept of protocol business and show that there's real revenue at stake here. There's also revenue distributed to token holders that are at all-time highs. And what we've seen there is that they are winner takes most dynamics, but it's very dynamic. And so I think 25% of the top 10 weren't even there the quarter before. So it is actually quite, really? In DeFi applications, which is by far the most fee generating sector, it's actually very, very dynamic. You mentioned Aave. Yes, borrowing lending was the one that seemed to be very sticky. As we've seen in the last 2 weeks, it's not so sticky anymore.
Yeah, got that right.
And then I think, yes, if we've always thought it was very important to evolve with this industry. Crypto basically, someone made an analysis, moves about 25 times the speed of the legacy financial system. You need to evolve. And yes, we do hear from some other crypto VCs that they sort of, our deal flow is stale. We're not seeing a lot of opportunities. We're seeing more deal flow than ever. We're having a really, really hard time and need to lean heavily into AI to keep up. But yes, these are different opportunity sets. They are not the typical like, hey, we're doing, here's a new DeFi protocol, we're doing perp trading on chain. This is much, much more specific in industries that are leveraging basically blockchains to solve problems. And that goes beyond the sort of typical crypto VC sphere that we used to have.
And is it exogenous opportunities? It's no longer, like you're saying, the perps, DeFi opportunities that we've become accustomed to. It's similar to things like, was it Figure HELOC on-chain credit going into the housing market, or is it USDAI going into the AI market, GPU financing? They're kind of going into these industries adjacent to crypto rather than building intrinsically.
Yes, so exactly. So the way, right, we had this infrastructure phase that was about crypto and, crypto infrastructure. And now what we're seeing that, right, and I'm coming back to basically finance, and not just the financial system of like Wall Street, the way we understand it, but all of finance, corporate finance, personal finance, everything will run on blockchains. It's not that everybody's going to a DeFi wallet to now run their finances in a DeFi wallet. It is just that all existing applications and new use cases are basically are being built on blockchain rails. But it is more that these industries exist. You have entrepreneurs from existing industries, and they're leveraging blockchains in a very specific way to solve problems. Versus like, hey, everybody, we need to move everybody into DeFi here.
Got it. Yeah, it makes complete sense. And so, I mean, as we kind of look forward to, 3, 6, 9 months down the line, actually, I'm curious, I'm sure it's not months, it's more like years. What is your time horizon for some of these things? And I'll just say, we've done some angel investing. It's not quite to the scale of the venture, funds that you guys are raising, just our own capital here, no outside LPs. And, a lot of these things are, they're in the cliffs, and we've got some, unlocks that are coming up, but it feels like really to understand the value capture that some of these things have, the opportunities here, it's a matter of maybe, is it 5 to 10 years? What generally, when you target a time horizon for some of the opportunities that you're talking about, going into these adjacent business models, bringing blockchain technology, making these things more efficient. Are you targeting token launches now, or are you targeting something bigger, further raises or exits or going public? And then what is the time horizon that you see to ultimately realize some of these investments?
I think it's why we like venture funds. We like 5 to 10 year timeframes. I think it's really that's the right expectation management. We've had periods where, gains were much quicker, but I think those were extraordinary circumstances and largely driven by macro. And I think, 5 to 10 year timeframes are, I think, the right ones. And I think for tokens in general, it's a bit of an, identity crisis, I think, since October 10th. Yeah. I think there, again, it has to come back to real product market fit, revenue being distributed to token holders, akin to, dividends, etc. And I think also the legal rights of token holders has to be established in a more clear way, ideally through regulation, right? And so that, again, regulation is, we've seen, these high cost of trust markets, they're usually very regulated because you have a lot of intermediaries that are, providing the trust, but that also usually means they can run away with the money. You have counterparty risk, right? And that, for that reason, we do have, very rightly so, a lot of regulation. And for that to change, we've basically seen how stuck this industry was without clear regulation. And we got the first was the stablecoin bill, and then what that has unleashed. And now we're hoping that, I think this year, maybe even before the midterms, we get the next bill that enables broadly, tokenization and finance running on blockchain rails. And I think that's, a little bit uncontrollable, but it seems that the timing there is very, very good. And I think so for some of these finance applications, payment applications, I think the timelines are like 3 years. They're much faster, right? Because we're really at the top of the application layer, very, very clear use cases, very clear product market fit. That is much quicker. And then other things that are a bit more,
deeper down the stack
out there, that are a bit more, I don't want to say esoteric, but, things where the use case isn't very clear yet and people are finding that out. Those things are usually, I think, 5 to 10 years is a good timeline.
Makes sense. Yeah. And anything deeper down the stack could, it might, like you're saying, out there, esoteric, could take a bit more time to ultimately find the idea that ultimately arrives at product market fit. It takes more time for those to develop. The last thing I got for you is, if we look at the liquid market, and this probably goes especially true for the shorter time horizons, anything 3 years and sooner. The macro landscape seems to be very correlated to really everything out there in the liquid market right now. Feels very correlated to macro. Everything moves in unison with the war in Iran, and then you've got 4 out of the Mag 7 with earnings calls today. Fed decided to leave rates unchanged. In your day-to-day, how much are you paying attention to macro versus kind of putting that to the side and thinking, look, over 3 to 5 to 10 years, all these macro situations resolve themselves?
Yeah, so this is something I think it's very tempting with 24/7, every second price ticker. It's very important to ignore all that. I think even daily, weekly, monthly, quarterly, you have to kind of see if the market is telling you something, right? And sentiment. That's kind of how we see it. I think people are impatient. You want kind of every day you want something to happen, but and then people just trade on that, right? And then if we don't have anything in the industry to trade on, then okay, we'll start monitoring the situation, and then we trade on that. And I think that's fundamental difference between a trader and an investor. We're investors. We think the future is better than now. That's the only reason why you invest in the future. And I think as a trader, you sort of it's more like a zero sum mentality. Yeah. And particularly we've seen this in this industry before, that very, very good investors lost a little bit the patience and then started basically becoming traders. And I think that's something that we stay away from.
Yeah, makes sense. We've repeatedly had the same. I mean, patience is the name of the game. This is a consistency that we've heard from the smartest people that have joined the show, of which put you up there, Lasse. Really appreciate you coming on today. sharing your wisdom. No surprise, patience is ultimately what separates the winners from the losers, and setting up both the mindset as well as the tactical strategy to stay patient is ultimately what leads to success.
Thank you so much for having me. This was a pleasure.
Yeah, same here. Thanks so much for coming on. Would love to chat again soon. We'll see you next time.
Same
Thanks,
here.
Lasse.
See you soon. Bye-bye.
Bye. Love it. I mean, nothing new there, although, the fresh perspective is always very, very great to hear. And so, guys, patience is the name of the game. Obviously, you see, we stay disciplined. We're here day in and day out, bringing you guys the latest. But you can't get burnt out. You got to stay in the game, and ultimately, this is how you do it. You stay patient. You keep a long-term mindset. Keep your time horizons in mind, because this is ultimately what is going to lead everyone to the promised land. You got to see the thesis through, and that's ultimately what it's going to take. Guys, last but certainly not least, we're setting them up in the back. We've got Billy Miller, the COO at Securitize. He's going to be coming up next. And so I'm just going to do a bit of prelude here, get ourselves set up so that we've got Billy properly situated. These guys just announced and launched their partnership with ComputerShare. I'm also gonna do just a bit of research here on ComputerShare so that I get a proper breakdown, because this is arguably one of the larger announcements that we've seen come out of the industry as of late. These guys, I'm sure you guys know them. Securitize has been shipping nonstop. The mantra is tokenize the world. We've heard people from all over the world say this exactly. Tokenize the world. These guys are working with BlackRock. They're working with ComputerShare. ComputerShare is the world's largest transfer agent. Probably one of the most important companies you guys have never heard of. And so we're going to be bringing on Billy Miller to talk about exactly this and their partnership with ComputerShare, bringing the S&P 500 on chain. So let's do it. Billy, welcome to the show, man.
Thank you for having me. Happy to be here.
Absolutely. It's your first time on the show. I think we've been trying to make it happen for a while, but this feels as timely as ever. So yeah, welcome.
Happy to be here, especially today.
Yeah. Well, congrats on the partnership with ComputerShare. I want to dig into it. Why don't we just start? Quick intro. You're COO at Securitize. Give us a little bit of an intro as far as how you ended up at Securitize. Where were you beforehand? And then we'll dig into the meat and potatoes here with ComputerShare.
Sure. So Billy Miller, COO. So I've been with Securitize a little over 4 years now. I came to Securitize by way of an acquisition that Securitize made of a traditional stock transfer agency that I was running. So the majority of the past decade of my career has been spent working at a transfer agency. So I got intimately familiar with how the plumbing works behind the scenes of how companies issue stock and how you manage shareholders and corporate actions and shareholder meetings and all the fun stuff that everyone knows about, but doesn't really know how the sausage is made behind the scenes. So I joined Securitize to help bridge the gap between using the blockchain as the ledger of choice for a transfer agent to administer shares and the traditional rails, which have all been in place for the past 50 years. So it's been a really fun ride to help bring that modernization to an industry that is super important to our entire financial ecosystem. And now we're seeing a lot of the proof in the pudding with things like today that even the largest of the providers that represent the biggest companies in the world are now getting inquiries, or now they want to make these offerings themselves to all their issuers. So we're trying to grease the wheels and make tokenization more of an accessible reality for more and more public companies.
Very cool. And so that seems like a great place to start. So you were at a traditional transfer agency. They've been doing these transfer agencies the same way for 50 years. And then now we're moving this on chain. Give us a sense of just generally, I guess a good place to start is like, what is a transfer agency? What is its purpose? And how had it been operating for the last 50 years?
So if you're a company issuing shares, you could be an equity, issuer, debt, or you could run a fund and be an asset manager. Anybody that issues shares to end investors generally hires a company called a transfer agent. So the transfer agent is the agent for the issuer, and they're tasked with the responsibility of keeping track of who owns what and when. They help the investors perform critical functions like transfers. They pay out dividends. They help facilitate corporate actions like stock splits or mergers and acquisition activity. So they are a core feature that work directly with the issuers to serve the shareholders. And they're heavily regulated by the SEC. Many of the rules were written back in the 70s. So it's a core component that is done very traditionally. I mean, when I ran a traditional stock transfer agency, we had a mail center where we put checks in envelopes, and we had a fax machine that shareholders could send faxes to, transfer shares to their trust. So it's been a very manual process and industry. A lot of the big transfer agents have done a great job modernizing their systems with online portals and better customer service functionality, and it's always in an effort to improve your offering to the issuers because they're the ones who hire you. So I think we're right at the inflection point where all of the transfer agents across the industry are starting to pay attention to new technologies such as blockchain and tokenization and how they can harness it to make their own operations more efficient and effective, but also differentiate their offering to give the issuers and the shareholders they work with what they really want, and that is to engage with the shares however they want to.
Yeah, much more flexible, much more customizable, ultimately a better user experience as the users are the issuers themselves, and then they can convey this and pass on that value proposition to their shareholders. And so, you were at the transfer agency, Securitize acquired you guys, and then now you have Securitize, which is a transfer agency by way of acquisition, now working with ComputerShare, also a transfer agency. And so is the partnership here like, ComputerShare is one of the largest transfer agents out there for much of the S&P. I think I saw $70 trillion worth of market cap out there, if I got that number right. And so, I mean, incredible to see these guys have extreme product market fit with their transfer agency. And now Securitize, as I understand it, is a digital transfer agency. So is this kind of the modernization of ComputerShare? How will Securitize and ComputerShare be working together?
Yeah, I think it's important to note that there really is no such thing as a digital transfer agent. Transfer agents can register with the SEC. They can use whatever technology they want to administer the shares. And Securitize, as the first one embracing, blockchain and more digitized experience, it took that path, right? But the traditional agents that have the majority of market share and represent the biggest companies in the world, they may use traditional ledgers. These transfer agents they either build the technology themselves. It's like an in-house accounting system, sitting on a cloud or physical server. There are some transfer agents that still could theoretically use Microsoft Excel. So I think what this means is we have been pursuing tokenization in a native way. And when I say native, I mean that the issuers themselves, the public company's CEO that makes a decision and says, we want to tokenize our shares. We wanted to ensure that they had an outlet to do that in a compliant way. And the path to do that is through the transfer agent. So obviously, ComputerShare represents the majority of the S&P 500 and the biggest companies in the world. And when they are getting inquiries from both the investor base and the issuers and the CEOs that are interested in using this technology, we want it to be the core infrastructure to allow them to do this quickly. So Securitize, everything we've built, from the multi-blockchain connectivity to the DeFi utility and the integrations that we have, we now want to make that available to ComputerShare's clients. So if they go to ComputerShare and want to tokenize, that they have a quick and easy outlet to do that through the integration with Securitize.
So let's just, I don't want to talk in hypotheticals too much, but let's say there's several IPOs that are planned to happen very soon, right? And so without mentioning anyone by name, let's say, one of these larger IPOs that is set to happen pretty soon goes and they're working through their capital structure. They're working on this launch. They go to ComputerShare. That's going to be their transfer agent of choice, right? For one of these soon to be public companies. ComputerShare would say to them, hey, we've got Securitize technology at our fingertips. We can tokenize your public shares when you go live and when you IPO so that you've got tokens that represent actual shares on your cap table right alongside public shares on a regulated exchange. Is that how this works?
You're exactly right. And I don't want to speak for ComputerShare, but from our perspective, the objective is this is the biggest piece of the puzzle. It's solving the chicken and egg problem of for this market to build around tokenized securities, like the NYSE announcement that we had of building a market for tokenized securities. You need issuers to do that. And the tokenized equity discussions that have been happening and the market share that's growing is not directly related to the companies themselves. You know, these are other products that somebody else can issue and sell tokens for that don't actually represent shares on the underlying books of the transfer agent. So by ComputerShare harnessing the technology of Securitize, a pre-IPO CEO who wants to tokenize could now select the tokenization option off the menu that gives them a quick and easy path to issue shares through the transfer agent directly in token form to their investor base. And that's the piece of the puzzle. And the other pieces come with it where, you know, equity capital markets teams and underwriters can now build on this to complete on-chain offerings and be able to access an entirely new segment of investors that are hungry to own and trade and use these securities in DeFi, you know, to get a loan against them. So it kicks in the flywheel of activity by just getting the issuers a safe and compliant option to do it through a trusted partner like ComputerShare.
Yeah. I want to get into how a lot of these puzzle pieces are coming together. And so we've got the announcement that Securitize made with New York Stock Exchange, effectively this alternative trading platform that New York Stock Exchange is going to be launching with Securitize's help. And so correct me if I'm wrong, but effectively this is the venue, right? And then when you've got a venue, you know, this can be the most efficient venue, better than Hyperliquid, better than Binance, right? It's got everything at it. But you need assets, you know, whether those are equities or tokens or something in between. You need things to go back and forth. The venue provides the marketplace, but you need bids and asks flowing through on the asset itself in order to facilitate this market. This announcement with ComputerShare is going to enable the asset universe that will exist inside of the New York Stock Exchange alternative trading venue. Is that the right way to conceptualize some of the announcements that you guys have put out as of recently?
The goal would be for this to be a catalyst to help issuers get there themselves, right? Okay. It's the difficult part of doing native tokenization is if we want to do it the right way, where CEOs aren't complaining on X that, you know, don't buy these shares because we don't know what they are. We want CEOs saying, yes, we want tokenization. We want you to interact with this. We want this done through ComputerShare. It sends the signal of trust to the market that this isn't some crazy permissionless product that nobody understands. This is equivalent to you holding a stock certificate or a share in book entry, from the transfer agent. So it's the direct access point. Yeah. By giving the issuers the trust and the confidence to do this, then that gives them the ability to explore new market infrastructure. So we're trying to build this parallel universe of, we're not trying to rebuild the entire financial system. We're not the ones shouting from the rooftop that everything's broken, fix it. So I expect this duality to coexist where you have traditional market functions as it normally does today, while this new world can engage with tokenized securities, outside of how it is normally done today and build a new system around that. So I think this is the conduit to make that happen.
Yeah. And so this is the catalyst, the conduit, like you're saying, to ultimately tokenize the world, as you guys like to say. ComputerShare, as we talked about, is one of the largest transfer agents out there today. I think we said 60% of the S&P 500, $70 trillion in potential market cap to be tokenized. How much of that 70 trillion do you anticipate coming online? Like, this kind of feels like a new beginning, if you will. Now the doors are open, but it's still going to be CEOs of Disney and Nvidia and Coinbase and a lot of these companies that Computershare works with to ultimately walk through that door and flip the switch to tokenize those shares. What's the process for that to take place?
I think the best comparison is e-delivery. When e-delivery became a standard process, the more technical folks that were ready to adopt the technology all switched to e-delivery. I barely get any mail at my house today. But there are many people that still like getting bills, every week to their address and all that stuff. So it's not a flip of the switch, everything all of a sudden is tokenized. It is a gradual adoption curve, but we just hope to shorten the time frame by giving everybody the tools they need to get this job done. And when I first started in the transfer agency world, I actually had to convince issuers to switch from stock certificates to book entry shares. And for those who don't know, book entry is just a piece of paper statement that says you own shares on the books of the transfer agent. So CEOs would say, well, I like stock certificates. They look good and people like holding them in their safe downstairs. And while that is true, it was a very rapid adoption to get rid of stock certificates entirely. DTC, who used to have custody of all the stock certificates, has gotten rid of quadrillions of dollars worth of stock certificates through the years. So I expect this to be now a faster path to adoption, that now we have the right tools in place with the right trusted partners like Computershare, who represents all these issuers. And now Securitize doesn't have to go to 1, 2, 3 random, public companies to try to convince them. We're trying to put the technology at their fingertips to allow them to do this faster.
Yeah, it does feel like there is a sense of network effects at play here. We're seeing this idea of institutional FOMO. We're seeing it from a lot of these players. They see some of these tokenized funds. Now, all of a sudden, everyone's got a digital asset strategy. We're seeing this in stable coins as well. Everyone's got a stable coin strategy from these major banks. AI is another one. Everyone's got an AI strategy. Once, their research and development department, becomes very active, that starts to feed into the rest of these companies one by one. And so it makes sense that as tokenization continues to proliferate, look, Larry Fink, the powers that be, these guys are shouting this from the hilltops, and it is permeating the rest of the minds of the decision makers at these companies. And so now we've got enablement for 60% of the S&P. What's the process for the rest of the 40%? Is it we're just knocking down these transfer agents one by one?
Well, I also sit on the board of the Transfer Agent Association. I'm a big fan of the industry association, and I know many of the other transfer agents. My objective from the start of why I joined an organization like that is to help modernize, right? We want to embrace new technology. I'll never forget one of the first conferences I went to, a blockchain enthusiast came and spoke and said, "Blockchain's here, you're all dead." Right. That was almost a decade ago. And here we all are, where transfer agents are in the news now for good reasons. Right. So I don't believe that blockchain overnight kills all these regulated entities that serve a core critical purpose. But I also want to see all the agents adopt this technology. So just like you said, every C-suite and every board is having a discussion on the tokenization and the AI strategy. I expect and hope that transfer agents are also considering this functionality to deploy at scale. Because for us as Securitize, the more companies that come on chain and do it the right way, where the issuers are the ones that are controlling the narrative and the shares, and the transfer agents are doing it in a regulated way with U.S. securities law, we're happy, because the pie grows, there's more activity, more capital comes on chain, and we get to do a lot more interesting things.
Talk us through, just in the final minutes here, the life cycle here. Now we have CEOs of public companies that are able to tokenize. They're able to work, directly with transfer agents as an issuer to determine what happens to those shares. They end up kind of, proliferating out there. Where do the shares go? And then ultimately, how do we track them? Like not verifiably, but how do we ultimately proliferate these shares far and wide? I'd imagine that, there's a value proposition here where, right now, there's access that's limited by tokenizing these things. Not only do we get 24/7, we also get broader market access. And so, we talked about issuance quite a bit here today because that is the primary highlight. But once these things are issued, just give us a sense of the rest of the life cycle of these shares as they make their way, into these shareholder registries and then ultimately into the hands of shareholders.
I think you hit the nail on the head. I mean, the key aspect of what this technology integration does is we are allowing shareholders to be a member of the shareholder registry. So how it works today, if I own a share of Apple, Apple's transfer agent has no idea who I am because I hold through a broker who holds through DTC. And then the transfer agent sees one line item, which represents the majority of the shareholder registry. So if you're holding in token form, it allows you the chance to be a direct participant on the books of the transfer agent. So you have better access to the issuer. The issuer has better transparency to their holding demographic, who's holding, who's transacting. And what blockchain as the ledger in that case allows it to do is you get to hit multiple ecosystems across the globe. And, we frequently say, we talk people out of tokenization in some circumstances because what matters is utility, right? Just because you tokenize or you use a blockchain to do some in-house ledgering, it doesn't mean it's a better ledger. It just means that if you have the right pieces of the puzzle to bring in DeFi, bring in multi-chain access and bridging capabilities, bring in on-chain corporate action and governance processes, and bring in markets that facilitate legal trading of these securities, then anybody that wants to hold in token form, anybody that wants to engage in this side of the house, they can. But guess what? If you don't want to do any of that, you can still transact as you would today. You can still go to your broker and buy shares and hold them there. You don't have to tokenize. So I think we're bringing the best of both worlds here and allowing the massive companies like ComputerShare to be able to harness the technology to deliver this quickly.
Yeah. Well, I think that's very well said, Billy. Appreciate you explaining not only how this partnership works, but also just generally the way in which we're modernizing the traditional equities holders value. It came a long way from the stock certificates in the safes downstairs. We're putting these things on chain, and we're giving back a lot of value in terms of the modernization process, bringing these things into the modern DeFi world. Really appreciate you coming on today. I know it was a last minute thing. We made it happen. Thank you for taking the time, and congrats on the announcement.
Thank you so much, Robbie. Enjoyed it.
Appreciate it, man. We'll see you next time. Thank you, Billy. And congrats to Securitize. Pretty epic to see. I mean, guys, this is $70 trillion in value. That's trillion with a T. And so it is epic. These guys are doing incredible work. Securitize once again comes through and dominates the game. I mean, ComputerShare is the largest transfer agent out there. 60% of the S&P 500, $70 trillion of market cap. This was the announcement of the day. We bring it to you live here on the Rollup the day that these things happen, and we're happy to do it. Shout out to Securitize. Shout out to all the guys at Securitize for making it happen and continuing to shepherd the industry forward, as well as go out into the traditional world, bring high quality equities, high quality assets into the DeFi world. This is what we want. We don't want to be messing around with these low quality shitcoins anymore. This is the time to bring high quality assets on chain and ultimately improve the entire value cycle that we have here. Guys, what a doozy of a show. Andy missed a good one, man. Missed a good one. I hope he's getting some waves down there at Bitcoin Beach. Why don't we just do a little recap here, guys? We had Adrien from Portofino. We had Shehram from Trust Wallet. We had Patryk from Serotonin walking through the state of on-chain credit. We had Lasse Counsel from 1KX, our friendly German fella. And then we finished up with Billy. Billy coming at us from Securitize. Very, very cool to see. And Pretty incredible day. FOMC came out. They said rates unchanged. Powell did say that was his last meeting as Fed chair. He will be staying on as governor. Market didn't really like to hear that. They want Powell out of there. I think we're going to see a lot more in a few hours. Just about 30 minutes, actually, when the market closes. We're going to have earnings from 4 out of the Mag 7. Watch out for volatility. Guys, stay on chain. Stay safe. We'll see you on the show tomorrow. Same time. Don't go anywhere. Just stay right here. Just watch the roll-up all night. We'll tell you exactly what you guys need to know. Appreciate it. To our team, to all of our guests. Guys, signing off. I'm Robbie. This has been the roll-up. You guys are great. We love you. Goodbye.